Hello and welcome to another class of financial accounting. My name is CMA Shobhit Paroha and today we are going to start a new chapter, that is chapter number 8, IAS to Inventories. Before we start our chapter, we should know what does IAS stand for. So IAS stand for International Accounting Standard. What does IAS stand for? IAS stand for International Accounting Standard. And in this chapter, that is chapter number 8, we are going to deal with International Accounting Standard number 2, that is inventories. So we are going to study inventories as per International Accounting Standard number 2, or we can say we are going to study all the topics which are related to inventories as per International Accounting Standard number 2. So we are going to study the meaning of inventories, the accounting for inventories, and the valuation method of inventories and disclosure requirements of inventories as per International Accounting Standard number 2, or we can say as per IAS 2. So we are going to study all these topics in this chapter. Then we are going to solve all the questions which are related to this chapter as asked by ACCA in your examination. Okay. So before wasting any time, we are going to start our very first topic, that is the meaning of inventory. The meaning of inventory has been divided into three parts. The meaning of inventory has been divided into three parts. We are going to study each part one by one, and then we will combine the entire definition of inventory to see which will be covered in the definition of inventory and which will not be covered in the definition of inventory. Okay, so now let's start with the definition of inventories. Inventories can be defined as asset. So what is inventory? Inventory is an asset held for sale in the ordinary course of business. So this is the part 1. This is the part 1 of the definition. Inventories can be defined as asset held for sale in the ordinary course of business. For sale in the ordinary course of business. Now, what does ordinary course of business mean? What does ordinary course of business mean? Suppose I am the manufacturer of this t-shirt. So I procure cloth, I procure thread, I procure cotton and other necessary things which are required to manufacture t-shirt. Then I get all these things into the production process and then manufacture the t-shirt and then sell the t-shirt in the market. So what is my ordinary course of business? My ordinary course of business is to sell this t-shirt. Okay. So whatever t-shirt I have in my office, in my godown, in my factory will become the part of my inventory or will consider as part of my inventory because this is my ordinary course of business. On the other hand, suppose I have a second hand AC in my office or in my factory which I need to sell. So will that AC become the part of my inventory? No, because that is not my ordinary course of business. Selling of AC is not my ordinary course of business, but selling of t-shirt is my ordinary course of business. Hence, all the t-shirt which I have will become the part of my ordinary course of business, will become the part of my inventory. But the selling of AC and that AC will not become the part of my inventory. That will be treated as non-current asset. Hence, the inventories can be defined as asset. In this case, both are asset. The t-shirt is also my asset and that AC is also my asset. Okay, but held for sale in the ordinary course of business. So I am going to sell that t-shirt in my ordinary course of business, but I am not going to sell that AC as my part of ordinary course of business. So that AC will not be considered as my inventory, but that t-shirt or that bunch of t-shirt will be considered as my inventory for the meaning of inventory. Okay, so what is the first meaning of inventory? Inventory can be defined as asset held for sale in the ordinary course of business. It should be sale in the ordinary course of business. So this is the part 1 of the meaning of inventory. Okay, and what is example of this? That is t-shirt held for sale, and which will be considered as finished goods, because that t-shirt is readily available for sale because it has been completed. All the things which are required to do and making of that t-shirt has already been done. So this is the my final goods. Okay, so the part 1 of the meaning of inventory is for sale in the ordinary course of business. Okay, now comes to the second part of the meaning of inventory. So now start with the very first line. Inventory can be defined as asset held in the process of production for such sale. What does this mean? This means that anything which is in the process for production for such sale will also be considered as the part of inventory. Like I am in the manufacturing process of the t-shirt. Suppose I have some t-shirt which is about to get completed, which are not 100% completed but about to get completed. that t-shirts will also be considered as part of my inventory. Like t-shirts in the intermediate stages of completion will also be considered as my part of inventory, because that are work in progress, so anything which is in the process of production for such sale will also be considered as my part of inventory. So we have studied two part of the meaning of inventory. First it, that is for sale in the ordinary course of business, that are finished goods, and then held for in the process of production for such sale, like goods which are not fully completed, which are not 100% completed but are in the stage of completion for such sale, will also be considered as my part of inventory. Okay, so any t-shirt or anything which is about to get completed will be also considered as my part of inventories, and it will be termed as work in progress. Now the third meaning of the inventory, the third part of the meaning of inventory is inventory can be defined as asset held in the form of material or supplies to be consumed in the production of goods or rendering of services. Suppose whenever I manufacture these t-shirt, I have to get that fabric, I have to get these buttons, and I have to get that thread to manufacture this t-shirt. So all that fabric, buttons and thread will also become the part of my inventory. That raw material will also become the part of my inventories. Example, cloth fabric, cotton thread used to manufacture t-shirt. That raw material will also be considered as my part of inventory. That is raw material. So now if we combine the entire definition of inventory, so inventories can be defined as asset held for sale in the ordinary course of business, ordinary course of business is very important. Like selling that AC will not become the part of my inventory, but selling the t-shirt will become the part of my inventory. Or in the process of production for such sale, or which is in the process of production for such sale, like anything which is about to get completed will also become the part of my inventory and will be termed as work in progress, and we'll use WIP as the short form for work in progress. Or in the form of material or supplies to be consumed in the production of goods or rendering of services. So anything which is used to be consumed in the production for such goods or rendering of service will also be considered as my part of inventory, that is raw material. So this is the meaning of inventories. The assets should be held in the ordinary for the sale in the ordinary course of business, or in the process of manufacturing of that good, or in the to be consumed in the production for such goods or rendering of service. So this is the meaning of inventory as per International Accounting Standard number 2. Okay, now I'm going to zoom in the screen to, so that you can read in the proper definition of the inventory. Then we'll start with the new topic. Okay, so read it in within a 1 or 2 minutes, then we start with the new topic. Okay, so I hope you have read the definition of inventory. So what is inventory? Inventory is an asset held for sale in the ordinary course of business, or in the process of production for such sale, or in the form of material supplied to be consumed in the manufacturing of that good or rendering of service. Okay, so this is the meaning of inventories. The examples are given here, that is t-shirt held for sale, t-shirt in intermediate stage of completion, and clothes and fabric or cotton thread used to manufacture that t-shirt. They all three will become the part of your inventory. But anything which you are going to sell which is not in your ordinary course of business will not become the part of inventory. Like we have discussed that AC thing, है ना? AC will not become the part of your inventory. Suppose Chroma is going to sell AC. Suppose Chroma is going to sell AC. So that AC will become the part of inventory of Chroma, because Chroma's ordinary course of business is to sell electronic items such as TV, fridge and ACs. But it will not become the part of my inventory, because selling of AC is not my ordinary course of business. Selling of t-shirt is my ordinary course of business. Okay. So we have studied the first topic, that is the meaning of inventories. Now start with the why does we need the valuation of inventory. Why does we need the valuation of inventories? Okay. So why does we need the value of inventories? Because it impacts the financial statement in two ways: the valuation of inventory and accounting adjustment. The valuation of inventories and accounting adjustment impacts the financial statement in two way. What are these two way? First, a potentially large balance within the current asset, and second, opening and closing inventory have a direct impact on the cost of sale and income and profit of the organization or the business. So why does we are going to study the valuation and accounting adjustment of inventories? Because it has two major impact in the financial statement. First is become the potentially large balance within the current asset, and second one is opening and closing inventory has a very direct impact on the cost of sale and profit. So now we are going to discuss how does valuation of inventory and accounting adjustment of inventory is going to impact our financial statement. So first one is potentially large balance within the asset. Okay, now we are going to start how does this impact our financial statement. Okay, suppose in the statement of financial position, in the statement of financial position, in the statement of financial position, or you can say balance sheet, we have following asset. We have following asset that are your current asset. Okay, suppose you have cash of dollars 100, you have receivable valuing dollar 200, and then you have bills receivable valuing dollar 500, and then you have inventories in your current asset, because inventory is a part of current asset. You have inventory in your current asset with the value of rupees 2500. Okay, now if we total this amount, using the calculator, you can also use the calculator. 100 plus 200 plus 500 plus 2500, that comes to total of 3300. So if we look closely, in this entire amount of 3300, that is the total of current asset, how much does the inventories weight, or how much percentage does the inventory carry? So if we divide the value of inventories out of total of current asset, that is 2500 divided by 3300, that comes to the 75.75 percentage. So in any organization or in manufacturing organization, the value of inventory can become the potentially large part of your current asset, like in this case. Okay, so suppose if inventory I have mentioned as rupees 2500 is actually is actually in the valuation of rupees $1000, but by mistakenly or by wrong calculation we have calculated the value of inventory as 2500, then this is going to give the wrong impression of your statement of financial position, and this is going to affect your entire business. Okay, so that's why it is important to have the correct valuation and adjustment of inventories. So this is going to impact your financial position in two ways. First one is it will become a potentially large part of your current asset. We have studied that first point, that is the valuation of inventory impacts the financial position in two ways. First one is a potentially large balance within the current asset, like in this case the value of inventory becomes a large amount in the total amount of the current asset. So that's why it is important to have the right calculation and right adjustment of the inventories. Okay, now the second one is, now the second impact is opening and closing inventory have a direct impact on the cost of sale and therefore income and profit. We'll see how this is going to impact our cost of sale and income and profit of the business. Okay, first we have to start with the very simple equation, that is sales minus cost of sales. Sales minus cost of sales comes to the total of gross profit. If you reduce cost of sale from the total sales, it will give you the gross profit. Okay, now what does cost of sale means? What does cost of sale means? Cost of sale is equals to opening inventory. Cost of sale is equals to opening inventories plus purchases less closing inventories, less closing inventory. So what does cost of sale means? Cost of sale is equals to opening inventories plus purchases minus or less closing inventories. This becomes your part of cost of sale. That becomes your cost of sale. So what we have studied in the first equation, that is sales minus cost of sale is equals to gross profit. And what is cost of sale? That is opening inventory plus purchases minus closing inventory will become the cost of sale. Now we'll see how does the opening and closing inventories are going to affect your cost of sale and ultimately going to affect your gross profit. Okay, so we are going to study this with the very simple example. Suppose in example you have opening inventory of $100, and in during the year you have purchased goods worth dollar of 500, and you have closing inventories of $80. Okay, so you have opening inventory, you have purchased it during the year, and you have closing inventory of $18, and during the year you have made the sales of $2000. You have made the sales of $2000. Okay, so what is your gross profit? By using this amount, your gross profit is equals to what is the formula of gross profit? Sales minus cost of sale. What is the formula of gross profit? Sales minus cost of sale. So we'll use sales minus cost of sale. So what is your sale? Your sale is $2000 minus cost of sale. And now what does cost of sale mean? Cost of sale is equals to opening inventory plus purchases minus closing inventory. What is cost of sale? Opening inventory plus purchases minus closing inventory. So what is your opening inventory? Your opening inventory is $100 plus purchases, that is 500, minus closing inventory, that is $80. So if you do the calculation, $2000 of sales minus cost of sale will be equals to 100 plus 500 minus 80, that comes to the total of 520. So what is your gross profit? 2000 minus 520, that is 1480. This is your gross profit by using the following information. This is your gross profit by using the following original information. Okay, now I am going to change amount of closing stock and opening stock in each case, and we'll see how does the change in opening inventory and closing inventory is going to affect our cost of sale and ultimately going to affect our profit or income of the business. Okay, so now I'm going to do the first adjustment. Okay, this is my first example. Keeping everything same, I'll change first the opening inventory, then I'll change the closing inventory. Okay, so in this original question, I'm going to change the value of opening inventory to $150, and will keep the purchases as same of $500. We'll also keep the value of closing inventory to the same of $80, and we'll also keep the value of sales to $2000. So now I have only made change in the opening inventory. Now we are going to see how does it is going to impact our gross profit. What is the formula of gross profit? Gross profit is equals to sales minus cost of sale. Sale minus cost of sale. What is sale? Sale is $2,000 minus cost of sale. And how does we get the cost of sale? Cost of sale is equals to opening inventory, that is $150, plus purchases of $500 minus closing stock, that is minus closing inventory of $80. So $2,000 minus 150 plus 500 minus 80. Please use calculator while solving all the question of the subject. Okay, so that comes to 570, and ultimately my gross profit comes to rupees 1430. What I have changed? I have changed the amount of opening inventory. I have made change in the amount of opening inventory. In original question, the opening inventory is $100, and then change in uh, amended question, I have made the change in the opening inventory to $150. By changing the opening inventory to $50, my gross profit came down from 1480 to 1430. My gross profit came down from 1480 to 1430. So if I increase the amount of opening inventory, if I made increase in the amount of opening inventory, my gross profit is going to fall. My gross profit is going to fall. Okay, so this is the first relation between the opening inventory and gross profit. This is the first relation between opening profit and opening inventory and gross profit. Okay, now we'll see how does change in the opening inventory going to impact the cost of sale. Okay, so in first question, in original question, my cost of sale came to 520. My cost of sale came to 520, and in amended question where I have changed the value of opening inventory, the cost of sale came to 570. Cost of sale came to 570. So if I increase the value of opening inventory, my cost of sale my cost of sale is going to rise. My cost of sale is going to rise. Hence, increase in cost of sale is going to ultimately give the decrease in the gross profit. Okay, so this is the first relation which happened when the change in opening inventory is made. Okay, now I am going to make changes in the closing inventory, and we'll see how this is going to impact our profit and cost of sale. Okay, so this is our original question. This is our original question, and I'm now going to make change in the closing inventory. Okay, second, opening inventory, same $100. Okay, same $100. Then purchases of $500, and then we'll change the amount of closing inventory. We'll change the amount of closing inventory from $80 to $60. Okay, we'll make the change in the amount of inventory from $80 to $60, and we'll keep the sales as same as above, that is $2,000. Okay, now if we are going to calculate our gross profit, so the formula is gross profit is equals to sales minus cost of sale. My gross profit is going to sale minus cost of sale. Sale is $2,000 minus cost of sale. Cost of sale is opening inventory plus purchases during the year minus closing inventory. That is $2,000 minus 100 plus 500 minus 60. That comes to the total of 540, and my gross profit is 1460. My gross profit is 1460. In the original question, my gross profit was 1480, and now my gross profit has came down to 1460. So what I have done, I have decreased the value of closing inventory. I have decreased the value of closing inventory by $20, which impacted my gross profit in the same way. Right? By decreasing the value of closing inventory, my gross profit also decreases. My gross profit also decreases. Okay, so this is have the direct relation between the closing inventory and gross profit. Okay, and how does it going to impact my cost of sale? In the original question, my cost of sale was $520. My original question my cost of sale is $520, and in the amended question, that number 2, my cost of sale came to 570, my 540, my cost of sale came to 540 from 570 to 540. So by decreasing the value of closing inventory, my cost of sale is also decreases, my cost of sale also decreases. Okay, so this is the direct impact between opening inventory and closing inventory in our cost of sale and gross profit or total income of the business. This is the relation. You can now do multiple permutation combination where you increases the cost, where you increases the amount of closing inventory or decreases the amount of opening inventory. This is going to impact your cost of sale and profit of the organization. Okay, so this is the relation between opening inventory and closing inventory. Hence the point is, valuation of inventory and accounting adjustment of inventory is going to impact our financial statement in two ways. First one is, it will become the potentially large part within the current asset that we have already seen. If the amount of current asset, if amount of inventory in the current asset is significantly potential, then it will give the wrong impression about the statement of financial position. Second, the opening and closing inventory have a direct impact on the cost of sale, sales and therefore income and profit. So there is a relation exists between opening inventory and closing inventory with respect to the cost of sale and gross profit. So what is the relation? I have made the simple chart for you to know what is the relation between the cost of sale and gross profit with the closing inventory and opening inventory. First, if closing inventory is overstated, your income will be also be overstated, and if the opening inventory is overstated, your income will be understated. In same way, if the closing inventory is understated, your income will be understated. And if your opening inventory is understated, your income will be overstated. So if you look closely, you can find the relation between the opening inventory and closing inventory with respect to the income. What is the relation? The closing inventory have direct relation with income or profit, whereas the opening inventory has inverse relation with income. So every time you make increase in the closing inventory, your profit will also increase, and every time you make decrease in the closing inventory, your profit is going to decrease. In same way, if you are going to make increase in the opening inventory, your profit will decrease because it has inverse relation, and every time you are going to decrease in your opening inventory, your profit will increase. So this is the relationship between opening inventory and closing inventory with respect to cost of sale and profit of the business. Okay, I am now again going to put the screen on the full screen mode so that you can treat this particular topic and see the notes. Okay, I'll give you 2 minutes for all this. Okay, so I hope you are done with the reading of these topics. Okay, now we'll see what are the accounting for inventories. How does we accounting of inventories done as per International Accounting Standard number 2. Okay, so accounting for inventories. Business will purchase raw material and goods for resale throughout an accounting period. Throughout an accounting period, these purchases are recorded in the purchase account bracket expenses at the point of purchase. So every time you make a purchase, every time you are going to make a purchase, what is the journal entry that you are going to do? That is purchase account, that is your expense account debited to payable or cash. If you have paid in cash, then cash. If you have purchased on credit, then payable. This is the first entry that is you are going to do. So this is going to saying the same thing, that these purchases are recorded in the purchase account expense at the point of purchase. At the year end, now comes the interesting part. At the year end, the total purchases appears in the statement of profit or loss, that is statement of profit and loss SPL, under the heading cost of sale, under the heading cost of sale or cost of goods sold. You can say cost of sale, you can also say cost of goods sold, both are same thing. To full stop, to determine the final cost of the sales figure, the business must adjust the opening and closing inventory. So what does business need to done? They need to adjust opening inventory and closing inventory along with their purchases to get the exact value of the cost of sale or cost of good sold. How they are going to do it? Just we have studied earlier. That is opening inventory plus cost of purchases minus closing inventory will become your cost of sale, will become your cost of sale. So this is the formula of cost of sale, that is opening inventory plus purchases minus closing inventory is your cost of sale. So how does the accounting for inventory is done? That every time you make a purchase, every time you make a purchase, you are going to record purchase as a expense, that is purchase account debit to payable or cash, whichever is the case may be. Then at the end of accounting period or at the end of financial year, you are going to adjust opening inventory and closing inventory to the cost of purchase, to get the value of cost of sale, to get the value of cost of sale, or you can say the cost of goods sold. COGS is the short form for cost of goods sold. So if you add opening inventory in your cost of purchase and if you subtract closing inventory in your cost of purchase, then you will get cost of sale or cost of goods sold during the accounting period. Okay, so this is the very simple topic which we have studied earlier also. Like the formula of cost of sale is opening inventory plus purchases minus closing inventory. Okay, you should remember this formula because this is going to be applied in every single question which is going to be asked in your examination. Okay, so this is the topic accounting for inventories. Let's move forward. Now what does cost of sale mean? So here is the formula of cost of sale. Now you are going to remember it for forever. That is opening inventory plus purchases minus closing inventory is the cost of sale. If you need to know the why this formula is derived, then I'm going to give you the logic why this is the formula for cost of sale. Suppose during the year you have opening inventory of $500 and you have made purchase around some dollars of 1200, and after the end of accounting period you have closing inventory left with the amount of $700. Okay, you already had $500 dollars of opening inventory, then you have purchased 1200 units of product, and at the end of accounting period you have left with the amount of $700 of inventory. So how much have you consumed, or how much of inventory have you sold? You had 500. Okay, then you have purchased further, that is 1200. So you had you have 500 plus 1200, that is $1700 of inventories during the year. You already held 500 as a opening inventory, plus you have made the purchase of $1200 of product. Okay. Now if we see the closing inventory of yours, so your closing inventory tell us that you already you only have $700 of inventories. You only have $700 of inventory. So the difference between the inventory you are supposed to have and the inventory you only have is $1000. That is, this is your cost of good sold. That is your cost of good sold, or you can say cost of sale, or you can say cost of sale. Hence the formula comes up to hence the formula becomes opening inventories plus purchases minus closing inventory is equals to cost of cost of sale. Now if we put the same value, we'll get the exact same answer. You have opening inventories of $500, then you have made the purchases of $1200, and at end you had left with the $700 of inventory. So 500 plus 1200 minus 700, that comes to the $1000 of cost of goods sold. So logically, this is the formula of cost of goods sold, that is opening inventory plus purchases minus closing inventory. Okay, very simple. So here we come with the cost of sale. Then what does opening inventory means? So opening inventory means value of inventory held at start of the accounting period. Whatever the amount of inventory you had at the beginning of accounting period will be considered as opening inventory. Then closing inventory. Value of inventory held at the end of accounting period will becomes your closing inventory, will become the amount of or value of your closing inventory. Okay. Now last but not the least, cost of purchases. Cost of goods purchased for resale or for all the directed cost, such as material, supplies, wages needed to make the goods. Okay, so whatever the raw material that you have purchased, whatever the labor that you have incurred to make the goods, whatever electricity expense you have made to get the manufacturing done, will also become the part of your purchase. Okay, so this is the meaning of following term, that is cost of sale, opening inventory, cost of purchase, and closing inventory. Just have a simple read about all these topics, then we are going to start our very interesting topic of year end adjustment entries. Okay, so start reading. I'm giving you another 1 or 2 minutes for this. Okay, now we are going to start the very important topic, that is year-end adjustment journal entries to ensure closing inventory and cost of sales reflect correct amount. Okay, what does this adjustment entry mean? We are going to understand with very simple examples and logic reason why does this journal entry needs to be done. Okay, see, if I have opening inventories of, if I have opening inventory of $500, and during the year I have made the purchase of $1200, and at the end of the year I am left with the closing inventories of, $700. This is the same value which we have used in the earlier example. Okay, this is the opening inventory, purchase made during the year, and closing inventories. Okay, now these opening inventories are your asset. These opening inventory are your asset. Okay, you have make sale of it because you had $500 of inventories, then you have purchased 1200, and at the end you have left with the 700. So what is the cost of sale, or what is the cost of goods sold? If I ask you, then it will be cost of sale is going to be 500 plus 1200 minus 700, that is 1000. Okay, this is the logical explanation of cost of sale. Now we have to do journal entry to get the same amount of cost of sale. Okay, suppose these opening inventory were your asset, so asset has a debit balance, were your asset, and asset has a debit balance. Now you are going to charge these opening inventory into your cost of sale. You need to charge these opening inventory in your cost of sale because you have already consumed these inventories. You have already made consumption of these opening inventory. So what is the journal entry that you are going to do? The journal entry that you are going to do is, opening inventory is a asset and has a debit balance. So to reduce the opening inventory, you need to do the credit of opening inventory because it has a debit balance. If you do the credit entry, it will get reduced to 0. Okay, so to opening inventory, and where is it is going to be charged? It is going to be charged in the head cost of sale. Cost of sale. And what is cost of sale? It is your expense. It is your expense, and your opening inventory was asset. So you have reduced your asset and made it to the charge of cost of sale. So the first adjustment entry that you are going to do at the year end is cost of sales account debit to opening inventory, where you make the your opening inventory, where you charge your opening inventory to the cost of sale. Okay, now the purchases we have studied earlier also. Every time you make a purchase, what is the journal entry that you are going to do? Purchase account debit to cash or payable. If you made the purchase in cash, then cash, or if you made the purchase on credit, then payable. Okay, so the purchase account is your expense. The purchase account was your expense. Okay, the opening inventory was your asset, the purchase account was your expense and has a debit balance. Expenses also has a debit balance. Now you need to net off this purchase account. You need to settle off this purchase account and charge these purchases to the cost of sale. Charge these purchases to the cost of sale. So if the purchase has debit balance, to net it off, to settle it off, you need to make credit entry. So what is the credit entry that you are going to make? To purchase account, and it will going to be charged in the head cost of sale. So you recorded the all the purchases as your expense in the head cost of sale. So this is the second entry that is you are going to do after the year end or on the end of the accounting period. Okay, we have studied two journal entries of, first one is opening inventory, where you charge opening inventory to the cost of sale, and second one is purchases, where you settle off or netted off your all the purchase to the cost of sale. Now at the end of accounting period, you are left with the amount of closing inventories. You are left with the amount of closing inventory. This closing inventory is your asset. This closing inventory is your asset. And asset has a debit balance. And it has not been recognized anywhere, because you had opening inventory which were recognized as asset in the last accounting period, and we have get the opening balance, and you have made the purchases which was recognized as expense and now transferred to the cost of sale. But that closing inventory has not been recognized yet. So now you need to make the recognition of this closing inventory as your asset. So if you make the recognition of closing inventory as your asset, you need to do closing inventory account debit. Closing inventory account debit. Okay. 2. So where to charge this asset? Where like you are making the recognition of asset, so from where you will charge this asset? So you are going to charge this asset from the cost of good sold. You're going to make the charge from the cost of good sold. Okay, or cost of sale. So cost of sale, that is $700. $700. Okay, and here is the amount will be $1,200, $1,200, and $500, $500. This is too messy. I'm going to make the proper explanation and presentation for this adjustment. Okay, just bear with me. So what 3 entries we have done and how this is going to impact our accounting, now we are going to know. First, you have made the debit of cost of sale. Okay, first debit is of rupees 500. So 500, that is cost of sale. First debit is of 500. Then you have made the second debit of 1200. So plus 1200. Then you have made the credit in the name of cost of sale of rupees 700. So 500 plus 1200 minus 700 comes to the total of 500 plus 1200 minus 700. That is $1,000. And with the debit balance, because this is your cost, this is your expense. Okay, now in first entry you had made the credit of opening inventory. Okay, so now let's see. Opening inventory, what do we have? The opening balance of opening inventory? Yes, that is $500. Okay, so $500 was already there. Now you made the opening inventory credit. So 500 debit, this is your debit balance, this is your credit. 500 debit minus 500 credit, that comes to the total of $0. That comes to the total of $0. Okay, so you have reduced your opening inventory and made it charged to the cost of sale. Now we'll see what happened with the closing inventory. Does closing inventory has any opening balances? No, because the opening balances are with the opening inventory and not with the closing inventory. So no opening balances. Now in third entry you have made closing inventory account debit. You have made closing inventory account debit. So 0 plus 500 debit is equals to $500 of closing inventory. So this is your debit balance and it is considered as asset in the statement of financial position or in balance sheet. Okay, so this will be considered as your asset. Now if we look to the purchase account, purchases made during the year are $1,200, were $1,200. Okay, so $1,200 of debit balance, that is expense. Okay, now you have charged the purchase account as credit. You have made the purchase account as credit. So less $1,200 of credit. $1,200 of credit. That comes to $0. So you have reduced your purchase account to 0. You have reduced your opening inventory to 0. Now you are left with the cost of sale, that is $1,000 having debit balance and will be considered as expense, and you are now left with the closing inventory having debit balance of $500 and will be considered as asset. So you are left with these two things, that is cost of sale and purchase and closing inventory. Okay, now you are left with these things. So this is the logical explanation of year-end accounting entries. Okay, now we are going to see how the concepts are written in our notes, then we'll see again the how we have done the adjustment. Okay, now just give a simple reading about this, then I'll going to explain you how this is going to be done. Okay, just have a simple reading in 1 or 2 minutes. Okay, now start with the very first topic, that is first adjustment. Remove the opening inventory. Removing the opening inventory. Opening inventory was your asset at the time of opening of accounting period. So the asset needs to be eliminated. So asset has a debit balance, so need to be eliminated, it need to be credited. So you credit the inventory asset and it will be charged against the cost of sale. It will be charged against the cost of sale. So cost of sales account debit to opening inventory. What does this do affected? It effect was opening inventory removed and becomes part of cost. Opening inventory has been removed and become the part of your cost. Second one. Okay, we'll see how we have done it in my example. Okay, we have done the same thing. Cost of sales expense account debit to opening inventory. We have done the same thing in our illustration. Okay, now second, close of the purchase account. Close off of the purchase account. Purchase account is your expense account or nominal account. It needs to be closed off. So purchase account has a debit balance because it is your expense account. In order to eliminate the purchase account, you need to make the credit of purchase account. So purchase account credit and will be charged against the cost of sales. Cost of sales account debited, and effect was purchase account closed off and becomes the part of cost of sale or cost of goods sold. Happy? This is the same thing we have done in our illustration. Cost of sale account debit to purchase account. Now, last but not the least, post the closing inventory. Post, most important, post the closing inventory. Closing inventory has not been recognized anywhere till now, till the end of accounting period. So in order to recognize cost closing inventory, you need to make the debit of closing inventory. So closing inventory asset account debit to cost of sale. To cost of sale. Effect cost of sale reduced and closing inventory recorded in your financial statement. So this is the 3 year-end accounting entry related to inventory that is need to be done at the end of accounting period. Okay, so This is the most important part of your chapter 8 international accounting standard number 2 inventories. Okay, I hope you are able to understand this complex topic in such a simple way. Okay, now we are going to start our new topic, that is stabilizing the quantity of inventory held by the organization. Stabilizing the quantity of inventory held by the organization. Suppose in a accounting period you have you have 12 months. Okay, and in these 12 months you make purchase 3 times a month, and you make sale 5 times a month. So what is the frequency of purchase? 3 times a month is your purchase and 5 times a month is your sale. So if I ask you what is your total number of purchases during the year, if I ask you what is the total number of purchases in the year, that is 12 months multiplied by 3, that comes to the 36, and total number of sales during the year. I am just telling about the number of sale, not the amount of sale. Okay, that is 12 months multiplied by 5, that comes to 60. Okay, so you have 36 transaction of purchases and 60 transaction of sale during the year. Now in order to know the quantity of inventory, how you are going to do it? How you are going to know the quantity of your value of inventory? How are you going to manually count the inventory, or you are going to use any computerized system or any book or any records to get the exact amount of the inventory? Okay, so now we are going to study how to get the exact quantity of the inventories. Okay, so this topic is stabilizing the quantity of inventory held by an organization. There are only two main methods to stabilize the quantity of inventory. Okay, so now we have to understand what are these two methods and how they are different from each and other. Okay, method number 1, the periodic approach. Method number 2, the continuous approach. Okay, first method is periodic approach, second method is continuous approach. Okay, in the name itself it is very clear that the periodic approach is need to be done at a particular period. And the continuous approach is going to be done in continuous manner. Okay, the continuous approach is need to be done in a continuous manner, or is implemented in such a way that is going to be do automatically in a continuous manner. Okay, now we'll study what is the difference between all these approaches. First, periodic approach, it is the traditional method. Then continuous approach, it is the alternative method. Okay, first one, that is periodic approach, was your traditional method, and the second one is your alternative method. Okay, now I'm going to tell what is the basic difference between these. Suppose your accounting period start from here and end here. Okay, your accounting period start from here and end here. In beginning of the accounting period you have opening inventory, and during this accounting period you make purchase throughout the accounting period. You make purchases all out throughout the accounting period, and at the end you are left with the amount of closing inventory. You are going to left with the amount of closing inventory and with the quantity of closing inventory. Okay, so in order to know how much of quantity of closing inventory you have, you need to do physical count. Physical count of inventory. So that you can know how much of closing inventory you have in your godown or in your position. Okay, so you are going to need to do is to count the all the closing inventory through physical count. Okay, so this is the periodic approach. This is the periodic approach. This is the periodic approach. Now, what is continuous approach? Suppose if I tell you that throughout the year I had opening inventory of $100 and I have made the purchase throughout the year of rupees $500, and at the end I am left with the closing inventory of I am left with the I don't know the closing inventory. So, and during the year my cost of sale were $300. My cost of sale were rupees 300. So why $300? Okay, so what is my closing inventory? So in order to find the value of closing inventory through continuous approach, you are going to use the formula of cost of sale. The formula of cost of sale is opening inventory plus purchase minus closing inventory. So how much of cost of sale you had? $300 is equals to opening inventory of $100 plus purchase it throughout the year $500, and at the end the amount which is need to be calculated, that is closing inventory. Okay, so $300 minus $600 is equals to minus closing inventory, that becomes to closing inventory is equals to $300. So this is the continuous approach where you use the formulas and accounting record to get the value of closing stock, So this is the continuous approach, and this is the periodic approach where you physically manually count the all the stock which you had in your godown or in your factory. So this is the basic difference between periodic approach and continuous approach. Periodic approach, you need to count, you need to make physical count of the stock, and in continuous approach you need to make the calculation through your records and books. Okay, so this is the basic approach. Okay, so that's why the periodic approach has been termed as traditional method, whereas the continuous approach has been termed as alternative method. This is the traditional method, this is the alternative method. Periodic approach ascertain inventory at a specific point of time, in a specific point in time. So in order to get the value of closing stock, you need to make a physical count. So you can't tell the amount of closing inventory you held until you make the physical count. So it will give the amount, it will give the inventory held at any specific point of time only. But in other case, continuous approach, you can have the inventory, you can ascertain the inventory at any time, because you can anytime use that formula, or you can anytime use your records and books of accounts to get the amount of quantity of inventory that you had. Okay, so this is the basic approach. Until you make the physical count, you can't tell how much of quantity you had, but in continuous approach you can get the amount of, or you can get the quantity of closing inventory at any time, because it will be recorded in your books. Another difference, inventory is counted at the end of period. It will be counted at the end of period, that is end of accounting period, when the business is closed, because you can't count the closing inventory when the business is in operation, because if business are in running condition or in operation, so many product will come, many product will go, so you can't make a exact amount of count. So business need to be closed at that particular physical count, with no inventory movement occurring, neither the goods are coming, neither the goods are going, nothing needs to be done. If you can only make the physical count if goods are lying there in your godown. Whereas in continuous approach, inventory is counted on a continuous basis. So every time you make a entry of purchase, you make an entry of sale, it's automatically gets adjusted and your closing inventory get changed. Okay. Manual card or computer records are not kept in periodic approach because you make the physical count every time you need to know the amount of or quantity of closing stock. But in continuous approach, inventory records are kept either on a manual card or on a computer records. These are the differences. In continuous approach, you are going to make the books of account, you are going to make the manual record. But in periodic count, you are not going to know, you are not going to maintain any record. Okay. It can be used to identify damage and lost inventory. This is the very important one. Every time you need to identify how much of inventory you have lost due to damage or accident, you need to make a physical count only. You can't do this through the continuous approach because the continuous approach is being recorded in the books or in a computerized system. So how does computer or books are going to know that how much of inventory has been damaged or lost? But every time you make a physical count, you are going to know that how much of the quantity of inventory has been lost or destroyed. So in order to identify the damage or lost inventory, you need to make a periodic approach or periodic and you need to make a periodic approach of physical count. So in periodic approach only you are going to identify the damage or lost inventory. It will provide an accurate record of the volume of inventory held at the period end. Why periodic approach will give the accurate amount as compared to continuous approach? Because suppose if some of my employee stole some of my inventory, if some of my employees has stole the some of my inventory, so how does the computer records is going to know about that stolen items? How does computer record are going to know? They are never going to know that this amount of inventory has been stolen by my employees. But every time you make a physical count in your periodic approach, you are going to know that how much stock you accurately have in your godown. So periodic count will or periodic approach will give you the exact or accurate calculation as compared to the continuous approach. So this is the difference between two approaches of stabilizing the quantity of inventory held. Okay, just give a 2 or 3 minute reading, and whatever the part I have highlighted or whatever the part has been written in red is very important for your examination because ACCA continuously asks this type of question. Okay, so just give a read in 2 or 3 minutes and then we start with the next topic. Okay, so now I think you have done with the reading of difference between periodic approach and continuous approach. Now we are going to start our last topic of the today's class, that is valuation of inventory. It is valuation of inventories. As per International Accounting Standard number 2, that is inventory. As per International Accounting Standard number 2, that is inventories. Inventories are to be valued at a lower of cost or NRV, whichever is lower. Every time you make the valuation of inventory, it is to be the lower of cost or NRV. NRV means net realizable value. NRV means net realizable value. Suppose you have following items like P, Q. R, and cost of P, Q and R and NRV of P, Q and R as follows. The cost of P is 10, the cost of Q is 12 and the cost of R is 15. Okay, and in NRV of these items are as follows. The NRV of P is 12, the NRV of Q is 18 and the NRV of R is 13. So you need to make the valuation at a lower of cost or NRV, at a lower of cost of NRV, whichever is lower. So if we see the P, which is lower, cost or NRV? Cost. So we are going to measure P at 10 rupees because 10 is lower than 12 as compared to cost and NRV. Okay, if we look at Q, cost is 12, NRV is 18, which is lower? Cost. So we are going to value Q at 12 rupees. And if we look at R, so R has a cost of 15 and NRV as 13, so which is lower? 13. So we are going to value R as 13. So the total value of inventory comes to 10 plus 12 plus 13, that is 35, and if you make the total of cost, so the total of cost is 10 plus 12 plus 15, that comes to the total of 37, and if you make the total of NRV, that is 12 plus 18 plus 13, that comes to the total of 43. So you need to value inventory at a lower of cost or NRV, that is 10, 12, 13 and total of 35, and this needs to be done on a line to line basis. Like, you can't say that total cost is 75 and total NRV is 43, so we are going to value our inventory at 37. Sorry, if the total of cost is 37 and total of NRV is 43, you can't say that we are going to value our inventory as 37 because cost is lower than NRV. No, you need to identify these items on a line to line basis. Like for P, cost is lower, for Q cost is lower, but for R, cost is more than the NRV. So we have measured R in the terms of NRV because we need to identify items on a line to line basis and not on a aggregate basis. Okay, so what is the valuation of inventory as per International Accounting Standard 2 means that inventory needs to be valued at a lower of cost or NRV, and this rule, that is lower or cost or NRV should be applied as far as possible on an item or line by line basis, like item and line and line basis, hence no netting off. Like, you can't make the aggregate sum of cost and aggregate sum of NRV then compare the total of cost and NRV. No, you can't do this. You need to do the calculation by and identification by line on line basis. So for P, but whichever is a lower cost and NRV, so you get to know the lower value. Then for Q, the same way, which is lower cost or NRV, and then R, which is lower cost or NRV. Then whatever identified value you have valued, that is whichever is lower, the total of that will become the value of inventory, which like we have used in this example. Okay, so 10 plus 12 plus 13, that is 35 is the value of inventory, not 37, not 43. You need to do the valuation in line on line basis. Okay, so this is the very important topic of your chapter, and many questions are going to be asked from this chapter, from this topic, also this chapter, but from this topic. Okay, so what is the valuation of inventory? As per International Accounting Standard 2, valuation of inventory needs to be done on the lower of cost or NRV, and this is to need to be followed on a line to line basis and not of a aggregate basis. Okay, now, sir, what is cost, what is NRV? I am going to teach all of you. Okay, I am going to teach what is cost and what is NRV. First, see from where this concept has came. This is the example of prudence. We all know who is prudence. So this is the one of the example of prudence in presenting financial information which came from the fair presentation concept, which have came from the fair presentation concept. So this rule of lower of cost NRV is an example of prudence in fair financial information presentation and have came from the fair presentation concept This is important. One or two question has been asked from this particular line. So this rule of lower of cost NRV is an example of prudence and have came from fair presentation concept. Okay. Now, what is cost? So cost has three elements. We are going to understand each element line by line. Okay. Cost. The cost of an item includes first. The cost of an item includes first all cost of purchase. That is purchase price, import duty, but not sales tax. Why? Because you get the credit of sale tax such as VAT, GST. You get the credit, so it has not been included in the amount of cost. So sale tax has been excluded from the amount of cost. So what is included? Purchase price and import duties. Then second, what is second item that is included in the cost? Cost of conversion. Suppose you have made the purchase of material. Now you need to do some processing to get the finished product. Like if I need to make this t-shirt, I need to purchase fabric, cotton thread and many things. Now I need to do production of t-shirt. So whatever conversion cost is incurred to manufacture this t-shirt will also become the part of cost, such as direct labor, direct variable overhead, production royalties, allocation of fixed overhead, like depreciation. If the machine is going to be used to manufacture t-shirt, so whatever the depreciation that machine incurred will also become the part of cost. Okay, based on normal level of activity. But what has not been included in the cost of conversion, that is abnormal cost. Suppose 500 of my employees went on strike. So will that cost of employees based who are not working for me and went on strike will become the part of cost? No, that will not become the part of cost. Also, suppose 1 lakh rupees of cloth get wasted during the production process due to fire accident. 1 lakh rupees of fabric got destroyed. So will that become the part of cost? No, because that is abnormal loss. Because that are abnormal loss or abnormal cost. So they are not going to be included in the cost of conversion. Same administrative overhead. Administrative overhead is also not going to be included in your cost, because hiring a salesman, salary of a salesman, salary of a receptionist will not become the part of your cost, because that are not directly attributed to the cost of conversion of the goods. Okay, so what does cost include? Cost include following items: that all cost of purchase, that is purchase price, import duty, not sale tax, plus cost of conversion such as direct labor, direct variable overhead, production royalties, allocation of fixed overhead such as depreciation, but not any abnormal cost or administrative overhead, and other costs incurred in bringing the inventory to their present location in condition, that is carriage inwards. Suppose if I make purchase from New York to my plant at New Mexico, so whatever the cost is incurred to get that item from New York to New Mexico will become the part of my cost, that is carriage inwards. Okay, but not carried outwards, so whatever the amount you need to pay to get your product delivered to the customer that is carried outwards will not become the part of your cost, because it is not directly attributed to the production or purchase of such goods. Okay, so what does cost mean? Cost includes three items, that is all cost of purchase, cost of conversion, plus other costs incurred in bringing the inventory to their present condition and location. Okay, what is needed to be included? Purchase price, import duty, not sale tax, depreciation, yes, direct labor, yes, variable direct overhead, yes, but not any abnormal wastage or abnormal cost or administrative overhead, and not any carriage outward, but we will include carriage inwards. Okay, so this is the inclusion and exclusion of cost to get the value of cost. Okay, this need to be included or excluded in the value of cost to get the value of cost as per International Accounting Standard number 2. Okay, just give a brief reading about all these. Whatever I have written in red and then stated off is very important for your exam, because many questions are asked from these particular point which student gets confused. So just remind all which will not be included, which are going to be included in the amount of cost. Okay, done. Now see what is net realizable value. Okay, so net realizable value is the estimated selling price, minus estimated cost of completion minus estimated cost of necessary to make the sale. What is NRV? NRV is estimated selling price less estimated cost of completion less estimated selling and distribution cost. Then you will get the amount of NRV. Suppose you have a good name R which cost you $800. You have purchased this item at the rate of $800. Okay, but you are estimating that it will sell at a price of $1,000. It will sell at a price of $1,000. But in order to make this sale, you need to do further processing. Which will cost you $50. And you need to make a advertisement so that sale will be enabled. You need to make a advertisement for such sale, which will cost you again $80. And in order to get the product from your place to the customer place is amount to rupees, is amount to dollar of, that is your distribution cost, amount to dollar of, suppose $150. Okay, so the goods that you had cost you $800, and it is estimated to be sold at a $1,000. In order to sell this at $1,000, you need to make a further processing of $50. You need to make an advertisement of $80, and you need to incur a distribution cost of $150. So how much exactly net amount you are going to realize? What is the exactly net realizable value that is you are going to receive? Is rupees, is dollar. 1000 minus 50 minus 80 minus 150, that comes to, sorry, 1000 minus 50 minus 80 minus 150, that comes to 720. So this is your cost and this is your NRV, and the rule says Inventory should be valued at a lower of cost of inventory, that is 720. That is 720. So what is NRV? NRV means estimated selling price. Estimated selling price less estimated cost of completion, less estimated cost of completion minus estimated cost of selling and distribution. Estimated cost selling and distribution that is necessary to make the sale is your NRV. Okay. So what is the rule? What is the rule? The valuation rule. Okay, now we are going to discuss in a summary the valuation rule. Valuation rule as per International Accounting Standard number 2 is inventory should be valued at lower of cost or NRV. Should be valued at a lower of cost or NRV, and it should be done on a line on line basis, no netting off. Okay, so this is need to be done on a line to line basis or line on line basis. Okay, what is cost? Cost is the amount you have paid, so purchase price plus cost of conversion plus cost incurred to bring inventory in their present location and condition, and which is what things are not going to be included. That is, you can't include sale tax, you can't include your abnormal cost, you can't include your administrative overhead, you can't include your carriage outwards. These things you cannot include in your cost. Hence, in another way, what is NRV? NRV is estimated selling price minus cost of completion minus cost of making such sale. Cost of making sale, that is selling and distribution expenses, your NRV. So this is the rule, this is the valuation principle as per International Accounting Standard number 2. Give a read from start to the bottom and you will be able to understand what does this mean. Okay, just give a read. Okay, so now what we have studied till now in this class, we have studied what is the meaning of inventory, that is inventory can be defined as asset held for sale in the ordinary course of business or in the process of production for such good or in the form of material supplies to be consumed for the production of such goods or rendering of service. We have studied this, the meaning of inventory. Then we have studied why we need to make the valuation and accounting adjustment of inventory, how these are going to impact our financial statement. These are going to impact our financial statement in two ways. First, it will become a potentially large balance within the current asset. Second, that opening and closing inventory is going to affect our cost of sale and ultimately going to affect our profit or income. Then we have studied what is the relation between opening inventory and closing inventory with respect to our income and profit. Then we have studied accounting for inventory, how the opening inventory, closing inventory and purchase account are going to deal at the end of accounting period, है ना? What are the journal entry needs to be done and what are the effect of such journal entries. We have studied this. Then we have studied stabilizing the quantity of inventory held by the organization. We have studied there are two approaches. First approach is the periodic approach. Second approach is the continuous approach. Which approach has some benefit, some another approach and some disadvantage. We have studied all this. Okay. Then at last we have studied the valuation of inventory. Then the rule says that the inventory should be valued at a lower or cost or NRV, and this has came from the example of prudence in presenting financial information, which is based on the fair presentation concept. The rule for such valuation is that it should be applied on a line to line basis or line on line basis, and what is going to be included in the value of cost and what is not going to be included in the value of cost. Then at last we have seen the what is net realizable value. Okay, so in this class we have studied these following topics. Now we are left with the valuation of closing valuation of cost of inventory, method of valuation of cost of inventory, and disclosure requirement and valuation method and its effect on the profit. Now we are left with only three topics. We have studied and covered major topics of this chapter. Okay, now we are going to start solving the question. Whatever we have studied, all the question related to these topics we are going to solve right now. Okay, so just have a pen or paper, or you can use your calculator to solve these questions. These questions are from your ACCA study hub. This question has asked from your ACCA study hub, and it can be asked in your exams again and again. So this is based on your ACCA examination paper level. Okay. Question number first. Ali has bought $2,000 of inventories on credit. Ali has bought $2,000 of inventory in credit. How will this transaction affect the account of Ali business? How will this transaction going to affect the account of Ali's business? What has Ali done? Ali has bought $2,000 of inventory on credit. He had made a purchase. So what do you do when you make a purchase? You make journal entry of purchase account debit to cash or payable. Cash or payable. In this case, Ali has bought these inventory on credit. So purchase account debit to payable. Purchase account debit to payable. What entry needs to be done? Purchase account debit to payable $2,000 and $2,000. Now let's see what are the option do we have in our question. Option number 1. Purchase will increase by $2,000 and trade payable will decrease by $2,000. Is this the case? No. Purchase is going to increase, right? Purchase is going to increase, but trade payable will not going to be decreased by $2,000 because payable has a credit balance. Payable has a credit balance. So every time you make a credit on trade payable, it will increase, not decrease. Here, purchase is also increasing, trade payable is also increasing. So this is not the case. So first option is wrong because purchase is increasing, but trade payable is not decreasing. Option number 2. Purchase will increase by $2,000 and bank account will decrease by $2,000. Is this the case? No, because these purchases are made on credit and not on cash or bank basis. Okay, so second option is also not correct. Option number C. Trade payable will increase by trade payable will increase by $2,000 and bank account will decrease by $2,000? No, because we are not paying to the trade payable. We are doing the purchase. We are making the purchase. So option number C is also incorrect. Option number D. Trade payable will increase by $2,000 and purchase will increase by $2,000. Is this the case? So yes, this is the case where purchase will also increase and trade payable will also increase. So correct answer is option number D. Correct answer is option number D. Okay, we'll see and we'll check whether the answer are correct or wrong at the end of solving all these questions. Okay, we'll see. Question number 2. This is based on the valuation of inventory. We have not studied this topic yet, so we will solve in the next class. Okay. Question number 3. State whether each of the following statement about the advantage of keeping state whether each of the following statement about the advantages of keeping continuous inventory records compared with periodic and inventory record is true or false. What we need to do, we need to tell whether the following statement are true or false in comparison to the continuous inventory system with compared to the periodic inventory system. Okay. Statement number A. Inventory balances are readily available. In continuous approach, whether the inventory balances are readily available? Yes, these are available at any point of time. So this is true. Statement number B. More likely to identify damage or lost inventory? Whether in continuous approach you are more likely to find damage or lost inventory? Let's see what does the notes say about this. As per notes, the periodic approach, one minute. As per notes, in periodic approach, it is most likely to identify damage and lost inventory. So where you can identify damage and lost inventory in periodic approach and not on a continuous approach. So this statement about the continuous approach is wrong. Which is statement? B. This is false and this is true. Okay. Now see whatever the option B have. Option number A. Statement number A is true, statement B is false. So this is correct. Next we see option number B. Statement A is false, statement B is true. No, this is not the case. Option number C. Statement A is true, statement B is true. No, this is not also the case. In option number D, statement A and B both are false. No, this is not also the case. So answer is A. We'll check whether this is the correct answer as per the institute or not. Question number 4. According to IAS 2 inventories, which two of the following statements reflect how the inventory should be valued? Which two of the following statements reflect how inventory should be valued? Okay. Now we need to identify what two statements are correct or not. Statement number first, that is A. Lower of cost or selling price. Is this the valuation method? No. The valuation method was lower of cost or NRV. So the option number A is incorrect. Option number B. Each of item of inventory is valued separately. Yes. The rule of International Accounting Standard number 2 says that each item of inventory needs to be valued and identified on a line-on-line basis. Option number C. Each class of inventory is valued as a whole. Whether each class of inventory is valued as a whole? No. This should be done on a line-on-line or item by basis. Option number D. Lower of cost or not realizable value? Yes, this is the rule that inventory should be valued at a lower of cost or NRV. So what is the two options? They are B and D. A and C are incorrect. Okay. Then question number 5. This is also based on the effect of valuation on profit. We have not studied this topic yet. Now question number 6. According to IAS 2 inventories, which two of the following items are allowed to be included in cost? Which two items are allowed to be included in cost? Okay. First item, raw material. Yes, this is allowed. Second, Import duties, yes, this is also allowed. Option number C, abnormal wastage of cost, is this allowed? No, this is not allowed. Even if you look at the notes given, even if you look at the notes given, abnormal cost has been struck out. This is not going to be included in the cost. So this is not going to be included. Option number D, carriage outwards. Carriage outwards, no, this is also not going to be included in your cost of goods. This is not going to be included in the cost of inventory. Okay, so this is also incorrect option. So what are the correct option? A and B. Now, question number 7. I hope you are able to see the entire question. Okay. Mia has a product that cost $80. It has been in inventory. It has been in inventory for a few months, and now Mia believes that she could sell the product if she reduced the selling price to 75. What is the cost of the product? $80. And what is the estimated selling price? What is the estimated selling price? 75. So this is the cost and this is your NRV, and you need to do the valuation at the lower of both cost or NRV. Okay. What value should Mia place on the product if their financial statement and which accounting concept will impact on this decision? Okay. So which is what will be the value of inventory? That is $75 because cost or NRV whichever is lower. So in this case NRV is lower than the cost, and $75 is lower than the total cost of $80. So the answer is 75. Now question has one more part, like which accounting concept will impact on this decision? Which accounting concept is going to impact this decision? Okay. If you have studied, you will tell, like, first the value of $80 are wrong, so option A and option B are both gone. These are not correct option. Now you need to choose between option C and D. Now you need to choose between option C and D. Option C, value of $75 comma accrual concept, is this the answer? Or option number D, value of $75 comma fair presentation concept, is this the answer? We'll see notes for this answer. Okay, we are going to refer our notes. Our note says this is the example of prudence in presenting financial information comma based on fair presentation concept. So this is based on the fair presentation concept. So the correct answer is D. Correct answer is D because it is based on the fair presentation concept and not on accrual concept. The answer is D. Okay. So till now we have solved question number 1, question number 3, question number 4, question number 6 and question number 7. Okay. Question number 8 is based on the topic which we have not studied yet. Same with 9, 10. Okay. Okay. Now comes to the question number 11. We have studied this. For each of the following statement regarding period end inventory records, indicate whether the statement is true or false. What is period end inventory record? That is periodic. That is periodic approach. This is the periodic approach. So what are the statement true or whether the following statement are false? Okay. Statement A. Period end inventory records can be used to identify damage and lost inventory. Yes or no? Yes. In periodic approach only you can identify the damage or lost inventory. So this statement is true. Then option number B. Period end inventory records will provide an accurate record of the volume of transaction held at a period end. Yes. In periodic approach only you can have the accurate amount of quantity of inventory in your go down. Okay. Because you make the physical count. Option number C. Period end inventory record is carried out during normal working hours and does not affect the operation side of the business. Is this the case? Now we are going to refer the notes because you are not going to remember all things in just one class. So if we look at the periodic approach, we have seen inventory is counted at the end of period when the business is closed with no inventory movement occurring. So this is going to impact your business because you need to close your business just to make the physical count of the inventory. So this is going to affect your business. So this is statement, that is statement number C, is false. Okay. Option number D, staff may be required to work overtime during the period end. Yes, because you can't make physical count during the normal working hour, so you need to close your business after the working hour and when the staff is going to make the physical count. So staff is required or need to do overtime. So statement A is true, statement B is true, statement C is false, statement D is true. Okay. Now see whatever the option we have. Option number A, statement A false, statement B true, statement C false, statement D true. Is this the case? No. Is this the case? No. So we are going to mark is incorrect. Okay. Now option number B, statement number A true, yes. Statement number B false, no. Statement number C false, yes. Statement number D true, yes. In this case the B option is wrong, so they are not going to go with this option. Now see option number C, statement A true, yes. Statement B true, yes. Statement C false, yes. Statement D true, yes. This is the correct answer. But for the benefit of doubt, we are going to see last option also. Statement, that is option number D, statement A true, yes. Statement number B true, statement number B false, no. Statement is not right, it's true. Statement number C false, yes. Statement number D false, no. This is not the correct option. Okay, so the correct option is statement number C. The correct answer is option number C. Okay, so till now we have solved 5-6 questions of the topic which we have studied till now. Let's see what is the answer of these topics. Okay, so in option question number 1, what was the correct answer? Trade payable will increase, purchase will increase. So question number 1 answer is D. Okay, I'm going to write in a notepad. Question number 1, what is the answer? Option number D. In question number 2, now we have not attempted question number 3. Correct answer is option number A. Correct answer is option number A. Okay, then in question number 4, I am going to make a full screen. Now you can see screen easily. In question number 4, the correct option is B. Question number 6, correct option is A and B. In question number 7, correct option is option number D. In question number 11, correct option is option number C. Okay, so these are the questions that we have attempted based on the topics which we have studied in the first class of chapter 8. Okay, now we'll cross check it with the answers. Okay, where are the answers? At the bottom of each chapter. These are the answers. Now we need to compare these answers with our answer marked. Question number A, D, yes. Question number 1 ka D. Okay, then question number 3 A, question number 3 A, right. This is also correct. Question number 4 B, question number 4 B and D. What we have selected? We'll see. Both B and D. We have selected both B and D. So this is also correct. Question number 6 A and B. Question number 6 A and B, yes. This is also correct. A and B. Question number 7 D. Let's see. Question number 7 D. Okay, this is also correct. Question number 11 C. Question number 11 C. Question number 11 C. Okay, this is also correct. So we have solved all the question correctly. Sir, will this question come for our exams? Yes, this is the same question which has been asked earlier also, and there are many chances that it will come again for your exam. So these are the level of question which is going to be asked for your examination. So if you study these topics uh, in a good manner from the notes, you are able to solve all the question. You are able to solve all the question. After second class, we will complete this chapter and we will able to solve all the question related to this chapter. Okay. So this is the first class of your chapter 8, and what we have studied till now. So we have studied what is the meaning of inventory, what is the inventory or why we need the inventory valuation, and how it is going to impact our financial statement, and what is the accounting for inventory, what are the year-end adjustment related to the opening inventory, purchase and closing inventory, and how the quantity of inventory are going to be identified from the periodic approach and through continuous approach, and what is the difference between both. And at last we have seen the valuation of inventory based on the rule, that is cost or NRV, whichever is low. So I hope this class is uh, you are able to understand all the things in this class, and we'll see in the next class. Okay, thank you. Hello and welcome to the another class of your ACCA financial accounting. What we were studying? We were studying chapter 8, that is IAS to inventory. In a previous class we have discussed what is the meaning of inventory, then we have studied why the inventory valuation or accounting is necessary and how it is going to affect your financial statement. Then we have studied the accounting for inventory, where we have discussed how the cost of sale is calculated, that is opening inventory plus purchases minus closing inventory. Then we have studied the concept which are related to the year end adjustment entry regarding the opening inventory, purchases and closing inventory, and how it is going to affect our financial statement. Then we have studied the approaches which are regarding the valuation of inventory, that is periodic approach and continuous approach. Then we have studied the valuation of inventory principle, which is it should be lower of cost or NRV. Then after that we have studied what are cost, what are NRV, what is going to be included in the valuation or cost of inventory, and what is not going to be included in the cost of inventory. And we have ended our class with the concept of NRV, that is net realizable value. And after the all the concept, we have done some question which are regarding the concept which we have already discussed in our previous class. So for today we have first topic, that is method for calculation of cost of inventory, and then advantages and disadvantages of such method, and disclosure requirement, and last which is valuation method and its effect on profit. So for today we have only three topics to study, then we will end this chapter and we'll start solving the all the questions which are related to this chapter. Okay, so today we are going to complete this chapter in this class only. So let's start with the new concept for today, that is method for calculation of cost of inventory. In previous class we have studied the valuation of inventory, which is it should be lower of cost or NRV. So now when we have discussed cost, now we have to discuss what are the method for costing, what are the method for finding out the cost, for calculating the cost. So today we are going to study the methods of calculating the cost of inventory. Okay, so first of all, why there are methods? Why there are methods for calculating the cost of inventory? Because prices of inventory may rise or fall over the accounting period. Therefore, the order of sold inventory needs to be established to determine the value of closing inventory. Okay, now what it is saying? Let's understand with an example. Suppose your financial year or accounting period starts from here, that is 1st of April 2025 and ends on 31st of March 2026. You have some opening inventory here on the first day of the year. You have some opening inventory, then you have purchased some another inventory on 2nd of May, then some another on 30th of June, then some other on 15th of November. Okay, and in the same way you have made certain sales like on 10th of May, on 1st of July, and on 30th of December. So you what you are doing, you have opening inventory, then you have purchased certain inventory, then you have already sold some inventory during the accounting period. Now at the end of the year, what do you need to do? You need to find out the closing value of inventory, you have to find out closing value of inventory, which should be based on the valuation principle, that is cost or NRV, which is lower, which is less. Okay, now so you need to find out the closing inventory. So in order to find out the closing inventory, you need to find out what is cost, what is NRV. NRV we have already discussed, cost we have already discussed, but now in cost you have to find out the methods. You have to find out the methods of calculating the cost of closing inventory. Now you have to find out the methods for calculating the cost of closing inventory. Sir, why do we need to find out the cost of closing inventory and what are the methods? Suppose you have some inventory in opening, then you have purchased some, then you have sold some. Now my question is, what inventory have you sold, or which inventory have you sold? Because the opening inventory was costing me around something at the rate of rupees $100 per unit. Okay, the opening inventory costing was $100 per unit, but on 2nd of May when I have purchased another set of inventory, the costing per unit of the inventory rise up to $120 per inventory. Then my question is, so whatever the inventory have I sold on 10th of May, so which inventory have I sold? Of opening inventory or the from the inventory which I have purchased during the start of the year. So my question is whether I have sold inventory which was costing me $100 per unit, or I have sold from the inventory which was costing me $120 per unit. So question rises, what are the methods for calculating the cost of inventory? So my question is, what are the methods for calculating cost of inventory? Because prices may go up or down. Prices may go up or down. Suppose if I purchase product or item X throughout the accounting period. Okay, so if I am purchasing item X throughout the accounting period, so this is my accounting period. On the starting of the accounting period, that item X was costing me $100, then it was costing me $120, then it goes down to $80, then it goes up again to $90, and then it go up again to $150. Okay, so this is what I have written from green is my purchases. Then during the year I am also in sale. I am also in sale of item X. Okay, I am also selling item X, or I am also issuing item X for my manufacturing unit. If I am the manufacturer, then I will consume that item X and give it to my production sector or production department to produce and make the finished goods which I am going to sell. Okay, so I want to know that item I have sold or issued to my production department, what was it? It was from my opening, or it was from my next purchase, or it was from my next third purchase. So this is the question which arises, that how is the flow of inventory going to find out the cost of inventory, to find out the cost of inventory. So what is this paragraph is saying? This paragraph is saying inventory prices may rise, may fall over the accounting period. Therefore, the order of sold inventory needs to be established to determine the value of closing inventory. So, what we need to determine? The order of sold inventory, how the inventory is sold or issued to production department, whether it is issued from the very early lot or it is issued from the very early lot or very recent purchase. So we need to understand the order of sold inventory in order to identify or determine the or calculate the cost of inventory. Okay, so what is the question and why there is a need for methods of calculation of value or cost of inventory. Okay, so there are two methods. First one is FIFO, first in, first out. First one is FIFO, that is first in, first out. So whatever the unit of inventory you have purchased first will be issued first. Whatever the unit of inventory you have purchased first will be issued or sold first. So what is the example? Suppose in the accounting period you have opening inventory of X, that is 120 units at the rate of $10. Okay, then on 1st of April 2025 you have purchased again 100 units at the rate of $12. You have purchased another 100 units at the rate of $12. Then in the same accounting period you have sold some units, that is on 5th of May 2025 you have sold, suppose 110, suppose 130 units. Okay, you have sold suppose 130 units. Now I want to ask what is the closing value of my inventory if this is the case, and I have given you that I am following FIFO method. I am following FIFO method, that is first in, that is first in and first out. So what is first in first out? Whatever the purchase I have made earlier will be used to sell the inventory or will be used to issue the inventory for the production department. So whatever I have purchased earlier will be issued first. That is called first in first out. जो पहले आएगा वही पहले जाएगा. Okay, so I want to ask what is the value of closing inventory. I want to know what is the value of closing inventory. So what I am following the method that is FIFO. So if I have sold 130 units, if I have sold 130 units, so I will use first my opening inventory. I will use my first opening inventory because I am following the FIFO method, first in first out. So this was my earlier purchase, this was my first earlier purchase, so I will use entire 120 units in order to sell 130 unit. I will use entire 120 units in order to sell 130 units. So my format for calculation will be receipt, then issued, and the last column will be balance. And in this column we will have some columns like units, price per unit, then amount, then we will have same sub unit columns, units, price, amount, then again units, price and amount. So what I have opening inventory of 120 units at the rate of $100. So I will write opening inventory of 120 units at the rate of $10, that is $1200. Okay, now this is my opening inventory, so I will write OP for opening, short form of opening. Okay, now have I made any other purchase during that date? No. So no purchase, no issued. My balance will be 120 units of $10 each, that is 1200. Then on next day, on 1st of April, I have made purchase of 100 units. So I will write 100 unit purchase because it is received to me. I have received the inventory. Was received by me. So I will write 100 units of inventory received at the rate of $12. So my amount will be 1200 again, and no issued. So what will be my balance? My balance will be 120 units of 100 of 10 each, that is 1200, plus and 100 units of $12 each, that is 1200. This is my balance. Okay, this is my balance for the end of that day. Which day? 1st of April, when I have purchased another set of 100 units of inventory, that is item X. Now I have to make sale. Of 130 units on 5th of May. I have to make sale. So in order to sell, I will use red pen. Okay, so No receipt during that day because no purchase was made. Now I have to make sale. I have to make sale of 130 units. I have to make sale of 130 units. So when I checked my inventory balances, I have seen that my earlier stock of 120 units was there. So I can sell 120 units from there, and then for remaining 10, that is 130 minus 120, for remaining 10, I will use that my recent purchase. I will use my recent purchase. So I can use $120 from my earlier lot, that is first in first out FIFO, from this lot which is lying in my inventory. So 120 units at the rate of 10, that is 1200 has been issued. Now I have to issue 130 units. I have to say I have to issue 130 units. So remaining units, that is 10. 130 minus 120, 10 will be used from my next purchase. That is 100 units at the rate of 12 each. So I will use 10 units from the purchase at the rate of $12 each. So that is 120. That is 120. So this is I have issued. Now what is my closing balance of the inventory? Now what will be my closing balance of inventory? That is this is gone. This entire 120 units has been gone because it has been used to sell this inventory. So it has been used to sell this inventory. So my entire earlier lot of 120 units has gone for sale. Now what is remaining? That is 90 units at the rate of $12 each. That is comes to 90 multiplied by 12 comes to 1080. That comes to 1080. So the question is, what is the value of closing inventory? So my value of closing inventory is $1080, that is 90 units at the rate of $12 each, that is $90 at the rate of $12 each. So this is called FIFO, where first unit that we have purchased will be used first to sale, first in first out. This is one of the method of calculation of cost of inventory, that is FIFO, first in first out, where which you have purchased earlier will be used first for sale or will be used first for issue to the production department. This is the one of the example of FIFO. Now if you study the concept of FIFO, you will be able to understand more easily what is FIFO is all about. So FIFO, the full form is first in first out. The full form of FIFO is first in first out. FIFO assumes that the items of inventory which were purchased or produced first are consumed or sold first. So items of inventory which were produced or purchased first are consumed or sold first. So purchased first, produced first will be used for sale first or consumption first. And consequently, items remaining in the inventory at the end of the accounting period are those most recent purchase or produced. So whatever the item that you have left in your inventory or you have left in your closing inventory will be from the item which you have purchased most recently, because earlier what has been used for the sale or consumption, earlier purchases have been used for the sale or consumption. So whatever the closing inventory you will have, that will be from the most recent purchases, because we are following FIFO, first in first out. So whatever you have purchased on last will be there or available there as the closing inventory. So this is FIFO, first in first out. Okay, now we will do more question of FIFO related to this topic in order to understand the concept properly. Okay, so this is FIFO, first in first out. Okay, we can also solve some question for your reference. Okay, so let's see what are the questions for FIFO. Question 1 we have done. Question 2, Malik had the following inventory movements in business during the first quarter of 2025. On 1st of January 2025, Malik had 3,000 units in closing value at $1,50,000, assuming Malik uses a cumulative weighted average. So this is from cumulative weighted average. This is not a FIFO question. Okay, we will find what is the question which is related to FIFO. This one, question number 10. Okay, so this question is from a ACCA study hub, can be asked in exam and can be used to explain what is FIFO. Okay, so now study what is question number 10 is saying. Yen purchased the following inventory during the current accounting period. So N has purchased the following inventory during the current accounting period. Months are given, units received are given, total value of the purchase are given, then again months and units sold are given to you. Okay, the business has no inventory on 1st of January 2020 or 2002. That is, you have no inventory on 1st of January. So this means no opening. This means no opening inventory. You have no opening inventory left in your accounting period. Okay. Assume that Yen uses FIFO approach to stock valuation. What amount should be shown for inventory in the statement of financial position, that is balance sheet, at 30th of April to decimal places. So you can use decimal up to 2 places. So what you need to find? You need to find out what is the value of closing inventory. You have to find out what is the value of closing inventory by using FIFO. By using FIFO, so we have to use FIFO in order to find out the value of inventory. Now you have no opening inventory. You have no opening inventory in your question in your accounting year. Okay. Now you have to find out the value of closing inventory. Suppose, let's understand the question first. Okay, you have month given. So in January you have purchased 145 units at a total value of 290. You have purchased 145 units of total value of 290. Then in February you have made sale of 90 units. You have made sale of 90 units, but no value given, because what do you need to do a value? You don't need sale value, you need the value of inventory sold. You need the cost of inventory sold in order to calculate the closing inventory. You don't need sale value. Even if the question gives you the sale value, it is of no use of you, because you don't need sale value, because sale value includes profit or gross margin also. You need cost of the inventory sold, because you need to find out the closing value. Okay, so first transaction is where you have made purchase on January of 145 units at the total value of $290. Then in February you have sold 90 units. Then again on February you have made purchase of 270 units of total value of 675. Then in March you have sold 320 units. Then again in April you have made purchase of 240 units of total value of $672. So this is the transaction which are given to you. Now we need to find out the closing inventory. Now we need to find out what is the value of closing inventory. Okay, so we will draw our format of the solution, that is question 10. Okay, so first column is regarding receipt. First column is regarding the receipts. Then second column is regarding the issue, and third last one we of balance. So these are the three main columns, and in these main columns you have individual sub column, that is units, then price, then comes amount, then again units, then price, then amount, then again units, then price, then amount. Okay, so I will use green pen, I will use green color of pen when we will receive the inventory for first in, and then we will use red color pen or marker for first out, for issue or for sale. Okay, so you can easily understand what we are doing. Okay, so do we have the opening inventory? Do we have the opening inventory? No, we don't have opening inventory. So we will start with the purchase. So on January, we have made the purchase of 145 units of total value of 290. Okay. So N is 145 units of total value. 290 is not a price per unit. It is a total value of purchase. So what will be my price? What will be my price? 290 divided by 145. That is 290 divided by 145. Please use calculator in class also. Okay. So price comes to 2 dollars. Price comes to $2. Now, what is my second transaction? That is regarding the sale on February. Okay, but before recording the sale transaction, we need to record balance after each transaction. Don't forget that we need to record balance after each transaction, then only we will proceed with the next transaction, then only we will proceed with the next transaction. So we don't have any issue, we do not have made any sale. Then my balance will be 145 units of $2 each, that is $290 of total value of or total cost of inventory. Then we have second transaction, that is sale of 90 units in February. Then sale of 90 units in February. And what method we are following? We are following FIFO. So on the date of February, we have not made any purchase. So we have not received any inventory. Then what we have done? We have sold 90 units. So we will write 90 units in the column of unit. And what rate? At the rate of what rate? At the rate of $2 per unit. At the rate of $2 per unit. So we will write at the rate of $2 per unit, because that 90 units will be used from this balance. That 90 units will be sold from this balance of 145 units. So we will sold 90 units at the rate of $2 each. That comes to total of $120. That comes to the total of $120. Okay, $180. So my closing balance will be I had 145 units less 90 units sold. So my closing inventory item will be 55 units at the rate of 2 each. That comes to 110. Then comes to 110. So we have recorded our first transaction, then we have recorded our second transaction. Now comes to transaction third, that is we have done January, we have done February. Now we need to make purchase of 270 units. We need to make purchase of 270 units of at the value of 675. So what is the number of items? 270 and 675. So we will receive 270 at the total value of 675. That comes to 675 divided by 270 to the value of 2.5. So we have received 270 units at the rate of 2.5 per unit. That comes to the total value of 675. We have calculated this. How? We have divided the number of unit to the entire value. So we get price per unit. Okay. Now, do we have made any issue on the same date? No. So my issue will be nil, nil, nil. Now I have to write down my closing balance. So my closing balance will be, first I will write this closing balance. Which is my earlier purchase. So 55 units at the rate of 2 each, that is 110. Then I will write this recent purchase on my closing balance, that is 270 units at the rate of 2.5, that is 675. So this is my closing inventory on the day of this purchase, because I have to write balance after each transaction, after each purchase, after each sale, after each produce, after each consumption. I have to write my balance of closing inventory after each transaction, whether it is of purchase, whether it is of sale. Okay. Now, so we have also recorded the purchase made in the month of February. Now we need to record sale made in the month of March, that is 320 units. So when we are making sale, we don't have any purchase and we will record sale. So 320 units. But listen and see carefully. We need to make sale of 320 units. So we cannot write 320 directly because we are following FIFO method. So we cannot write 320 directly. We need to use FIFO. So my this lot will be used first, and then my this lot will be used first, because that 55 units I have purchased first. So that is first in, and that will be used for first out. So that 55 unit will be used first, then my 270 unit will be used in order to fulfill the sale. So how many do I have to sell? I have to sell 320 units. I have to make sale of 320 units. So I will use 55 from my earlier lot. Then for remaining, that is 320 minus 55, that comes to 265 will be used from this. So I will use 55 from here, and then I will use 265 units from my next purchase. So this is the concept of FIFO. This is the concept of FIFO, where earlier purchase will be used first and then the recent one. So in order to make sale of 320 units, I will use 55 units at the rate of purchase at the rate of 2 each, that is 110. Then I will use remaining unit, that is, please calculate 320 minus 55, that comes to 265. So I will use 265 from my next lot at the rate of 2.5. That comes to 265 multiplied by 2.5, that is 662.5. That comes to 662.5. So this is how I am going to make sale. This is how I am going to make the sale. So when I make sale of 320 units, my 55 unit will be all gone. My 55 units will be all gone and will be used for the sale. And whatever I left from this 270 units, that is 270 minus 265, that comes to 5 units at the rate of 2.5, that comes to 12.5. 2.5 multiplied by 5, that comes to 12.5. So I have used entire 55 units, then I have used 265 units from my 270 units. So only 5 units are left. Only 5 units are left. Now we have made the sale. Then we will see what is my next transaction. So when I see my next transaction, that is on April, I have purchased 240 units. Of 672 value. So I have purchased 240 units of 672 value. Again we can check 240 units of 672 value. That comes to the price per unit, that is 672 divided by 240, that comes to 2.8. Okay, so I have purchased this and no issue was made. So what will be my closing inventory? That is first 5 units at a rate of 2.5, that comes to 12.5. Then 240 units at the rate of 2.8, that comes to 672. So this is my closing inventory. Where I have the total units, that is 245, with the total value of 12.5 plus 672, that comes to 684.5. So this is my total value of closing inventory. This is my closing inventory. This is my value of closing inventory by using FIFO, that is first in first out, that is FIFO, first in first out. So if you look at this, you will notice that whatever the unit I have purchased first, I have used that purchase for my sale. So first in first out, whichever I have made earlier will be used first, that is first in first out. So this is my answer, that is $684.5 will be my value of closing inventory. Which is this question? This is question number 10 from the question bank. If you want, even I can check the answer with the solution. Okay, so let's check the answer. This is my question bank, question number 10. Let's come to the last page to see what is the answer. Question number 10, what is my answer? This 684.5. This is the answer, where we have find out the value of closing inventory by using FIFO. Okay, because the question asked us to use the FIFO method for the valuation of closing inventory. And what is the answer? 684.5. What is the answer? 684.5. Okay, so this is FIFO method for the one of the method of valuation or calculation of cost of inventory. There are two methods for calculation the cost of inventory. First one is FIFO, which is first in first out, where we have discussed that whatever the item or whatever the consignment you will purchase first will be used first for consumption or sale, which will be used first for consumption or sale. Okay, so now we have also done the one of the question of FIFO. So I am giving you 2 minutes to read out what is FIFO again, and then we can proceed with the other method. Okay. So you have 2 minutes to read this, and then I will again turn the screen into full screen where you can also see the calculation. Okay. So you have 2 minutes to read this. Then we will proceed with the next method. Okay. Okay, so I guess you have done with the reading of what is FIFO. Now we will proceed with the next method of value of calculation of cost of inventory. That is average cost. That is average cost. And short form is AVCO. That is AB for average and CO for cost. That is average cost. First method is FIFO. Then we are first in first out. Now we have to study FIFO. Then we have to study average cost. In average cost there are two sub method. In average cost there is two sub method. First one is periodic or simple average cost, where first one is periodic or simple average cost, then second one is weighted or cumulative cost. First one is periodic or simple average cost, and second is continuous or weighted average cost. Second one is continuous or weighted average cost. First we will discuss what is simple average cost. First we will discuss what is simple average cost, then we will discuss what is weighted average cost. Now suppose during the accounting period you have made certain purchases on different dates. You have made certain purchases of inventory on different dates. So suppose on first transaction or first purchase you have purchased 100 units at the rate of $10 each. Then on second transaction you have purchased 120 units at the rate of $8 each. Then on third purchase you have purchased 120 units at the rate of $7 each, and on fourth purchase you have purchased 50 units at the rate of $50 each. Okay, so these are the transaction of purchases. These are the purchases that you have made. Okay, these are the purchases. Now I am asking you, what is the value of, now I am asking what is the value of closing inventory if using, if you are using simple average, if you are using simple average cost of method, if you are using method of simple average cost. So what you need to do, you need to do is to find out the value of purchase. You need to find out the value of purchase, that is equals to 100 units multiplied by $10 each plus 120 units multiplied by $8 each plus third transaction, that is 150 units multiplied by $7 each, and last 50 units multiplied by $15 each. Okay, this is 15, this is $15 each. So this is the value of purchase that you have made, that comes out to the total of, that is 100 multiplied by 10, that is equals to 1000 m plus, then 120 multiplied by 8 m plus, 150 multiplied by 7 m plus. Do you know the function of m plus or m minus in your calculation? If you don't, then we will make a separate video on YouTube where we will discuss the calculator tricks. Okay, so last one is 50 multiplied by 15, that comes to 750, and then m plus, that comes to a total of 3760. Okay, so this is the value of purchase that you have made. 3760, and this is the total value of purchase that you have made. This is the total value of purchase that you have made in dollars. It should be divided by the total number of units that you have purchased. It should be divided by the total number of units that you have purchased, that is 100 units, 120, 150 and 50 units. So it should be divided by total number of units of purchase. 100 plus 120 plus 150 plus 50, that comes to 100 plus 120 plus 150 plus 50, that comes to the total of 420. So $3760 divided by 420 units, that comes to $8.95 each. So this is the cost of inventory. This is the cost of inventory per units by using simple average cost. By using simple average cost. So in simple average cost, what you do? You divide the entire value of purchase. You divide the entire value of purchase, that is 3760, by the number of total of all the units. That is by number of total of all the units, that comes to $8.95 per unit, that comes to $8.95 per unit. So this is the simple average method where you calculate the value of inventory by dividing the entire value of purchase by the number of units you have purchased. So this is simple average, which is very simple in concept also. So let's read what is the simple average cost. As the first line says, this is a very simple method where all the different cost of all the purchases slash production are added together and then divided by the number of units produced or purchased, then divided by the number of units produced or purchased. What we do? We add together the cost of all purchase. We add together the cost of all purchase or production, and then we divide it by the number of unit produced or sale. So if I ask you what is the formula, so the formula will be, the formula comes out to be cost of all purchase or production divided by the number of units purchased, that comes out to the number of units purchased or produced. That the same thing we have done here, where we have write all the value of purchase and divided by the number of units purchased, that comes to the 8.95, that is purchase price or costing per unit, that is costing per unit, because different level of purchase had different level of purchasing cost, because different level of purchase had different level of purchasing cost. So what we have done, we have done the use of simple average, where we divided the entire value by the entire total of the unit purchase. Okay, so this is the simple average for you. This is the concept of simple average for you. So what are the methods of calculating the cost of inventory? There are two methods. First one is FIFO. And second one is average cost, where you have two sub method. First one is simple average method or simple average costing method. Now the second one is continuous or weighted average cost. I will prefer it by saying weighted average cost, which is where you weight the cost each time of purchase or receipt of inventory, where you make weightage of whenever you purchase or receive the inventory. It is called weighted average cost. So we have discussed what is simple average. Now we are going to discuss what is weighted average cost, which is weighted average cost. Okay, so in the same example, or we can take another example for this, that is, suppose on first transaction you have purchased 100 units. Okay, you have purchased 100 units, or we can use the question from the question bank only. So that we will understand the concept also, we will do the question also, and we will done the question bank also. So our three purpose will be solved if we solve the question from the question bank. Okay, so this is the question which we need to solve, question number 2, most important question. Okay, this is one of the most important question for you, and it is favorite of ACCA Institute. So mark a star on it that you will solve this question by yourself in home also. Okay, I am also solving this question in the class, then you will also solve it in the home also by yourself. Okay, so now read the question. Malik had the following inventory movements. Movement means sale or purchase, receipt or issue. Come in and come out. Okay, in and out. So Malik has the following inventory movements in the business during the first quarter of 2025 or 2005. Okay, so these are the transactions that are given. On 2nd January 2005 or 225, they have made a purchase. Of 5,000 units at the rate of value of $270,000. $270,000. So we will mark this movement in blue and or in red, green or red. Green will be for purchase and red will be for sale or issue. Okay. So first one is regarding the purchase of 5,000 units of value of $270,000. Then you have second movement, that is again regarding purchase on 10th of January of 6,000 units of the value of 3,48,000 Then on 17th of January, you have sold 4,000 units which of no value, because you don't need any value, you don't even need any value, because values are for sale. You need to use sale value, because sale value includes profit also. We need to find out the cost of items sold. Okay, so you have sold 4,000 units on 17th of January. Then comes another transaction, that is on 22nd of January, where you have again purchased, where you have again purchased 3,000 units of value $210,000. So you have three transactions of purchases and one transaction in between of sale. On 1st of January, now come again to the question. On 1st of January, Malik had 3,000 units in inventory valued at $150,000. Malik had 3,000 value of inventory valued at $150,000. What it is? It is your opening inventory. This is your opening inventory. Okay. So this is your opening inventory and these are the movement of purchase and sale during the year. Assuming Malik uses a cumulated weighted average approach. Malik uses a cumulated weighted average approach. We have two average, simple average and weighted average. So we have discussed simple average. Now we are discussing weighted average. Okay. So Malik uses weighted average cost approach to inventory valuation. What value would be included for inventory in the statement of financial position at 31st of January 2025? You had opening inventory on which date? 1st of January, and we need to find out the value of inventory on 31st of January, that is the end of the month, or you can say end of the period, or you can say we need to find out the value of closing inventory. We need to find out the value of closing inventory. Okay, so what question is saying? Question is saying there is a person named Malik who had the following inventory movement, where we will discuss that we have 3 made purchases and made 1 sale between them. Then we have opening inventory and we need to find out what is the value of closing inventory by using which method? Weighted average. Which method? Weighted average. Okay, so by solving this question we will understand why we will understand easily what is weighted average, and will question will also get solved. So we will do and we will fulfill two purpose from this exercise. Okay, we will complete our two purpose from this exercise. Now again we will come to our format, that is issue, that is receipt, issue and balance, that is sorry, receipt, issue and balance. Okay, now comes to solution of question number 2. Okay, question number 2. First column will be of issue, sorry, receipt, then issue, and last balance. Okay, now in sub column we will write units, then price, then amount, then again units, price, amount, and last again units, price, then amount. Okay, this is the one of the best format to solve all the question related to the valuation of or costing of inventory. Okay, now what method we are using? We are using weighted average method. We are using weighted average method. Now first, what do we have? First, what do we have? We have the opening inventory. We have the opening inventory. So for opening inventory, I will use blue marker or blue pen. For purchase or for a receipt, we will use green marker, and for sale, we will use red marker. This is our rule. Okay. So what do we have? We have the opening inventory. We have the opening inventory, that is 3,000 units of value of $1,50,000. So I will write 3,000 units of value of $1,50,000. Okay, now I need to find out the price per unit. I need to find out the price per unit. So what will be my formula? 150 divided by 3,000. So 150 divided by 3,000, that comes to the total of 50 units or $50 per unit. Okay, so I have written down the value of opening inventory. Now we will write the issue and receipt regarding the transaction. Okay, so let's go to the question and see which is the first transaction. So on 2nd of January you have the first transaction regarding the purchase, that is receipt of inventory, that is 5,000 units at the value of $2,70,000. So you have made the purchase of, we will use green color, you have purchased 5,000 units at the total value of 270, okay. You were not provided with the price per unit, so you will calculate accordingly. So 270 divided by 5,000, that comes to 54, Now have you made any issue on the same day? No. So no issue of inventory. Now understand what we are doing. Now we need to write down the closing balance. Now we need to write down the closing balance after the purchase. So can we write 3000 units of 50 each, 150, that is this one, and can we write 5000 units at a rate of 54, that is 270 from this? Can we write like this? Can we write like this? No, because if we write like this, then it becomes FIFO. Because if we write like this, then it becomes FIFO, and we are not solving the question by using FIFO. That is, we are not using first in and first out concept or method to solve the answer or to calculate the value of closing inventory. This is FIFO. We are not using FIFO here. So we cannot write like this. We cannot write like this. So how we are going to write? We are going to write like this. Suppose you had 3000 opening inventory, okay, in your balance. Then again you have made purchase of 5000. Then what is the total number of unit that you have? 3000 plus 5000, that comes to the total of 8000. That comes to the total of 8000 units. Then your earlier purchase was of 150,000, 1,50,000. Your earlier purchase was of $1,50,000, and then you have made purchase of $2,70,000. So what will be the total of 150 plus 270? Please add 1,50,000 plus 2,70,000. That comes to the total of $4,20,000. That comes to the total of 4,20,000. So now you have the value of inventory, then you have the number of unit that you have. Now divide this. From 4,20,000 divided by 8,000, that comes to the value of 52.5. That comes to the value of 52.5. This is your price per unit. So you need to do this. After each transaction. You need to find out the weighted average. After each transaction of purchase or either sale. Whatever the transaction there is, either purchase or either sale, you need to find out the value or cost per unit after each transaction by using weighted average method, where you sum up the total value of inventory that you had, then you sum up the total number of unit that you have, then you divide the total value from the total number and get the price per unit. You get the price or cost per unit. So this is how you're going to do. You don't need to follow FIFO method, or you don't need to follow simple average. This is a separate method which is called weighted average, and which is more complex as compared to FIFO or simple average. Because if you look at this for the first time, you will find it more complex as compared to FIFO and simple average. Okay, so we are going to practice this question a lot, then you will become more comfortable with this approach. Okay, so we have recorded our first transaction, that is purchase of 5,000 units of at the value of $2,70,000. Now we need to record another transaction, that is on 10th of January you have made purchase of $6,000 at the value of 3,48,000. So we need to record purchase of 6,000 units at the value of 3,48,000, at the value of 3,48,000. So we have recorded the purchase. Now find out the price per unit. So 3,48,000 divided by 6,000, that comes to 58. That comes to 58 per units. Have you made any issue on the date of 10th of January? No. So no issue for this, hence left blank. Now we have to write down the closing value. So 8,000 plus 6,000, that comes to 14,000 units. 8,000 plus 6,000, that comes to 14,000 units. Then 420 plus 348. So 4,20,000 plus 3,48,000, that comes to the total of 7,68,000. That comes to the total of 7,68,000. Now we need to again find out the price per unit. We need to again find out the cost per unit. So what we will do? 7,68,000 divided by 14,000 divided by 14,000 by using the calculator. So answer will be 54.8, 54.857, 54.857. You can use up to 2 decimal also. I am using up to 3 decimal for the most accurate or most correct answer. Okay. So my price per or my cost per unit is 54.857 dollars per units. Okay. So this is how I have recorded my another transaction. Now we will come again for the next transaction, which is regarding sale. Now you can understand more easily how it is going to affect and how it is doing, how we are solving the answer. Okay. So on 17th of January, you have sold 4,000 units of inventory. You have sold 4,000 units. So now we have to write out the issue or sale. So on the date of issue, you have not made any purchase. You have not made any purchase. So no entry on the purchase side. Now record the sale. So you have sold 4,000 units. You have sold 4,000 units. Now you will ask, sir, no information was given regarding the value of units sold or the cost of value sold. Then what? How can we do it? How we are going to find out the cost of value of items sold or inventory sold? So you need to use this value. You will use this value, that is 54, that is 54.857, that is 54.857. When you multiply 4,000 by price per or cost per unit, that is 54.857 multiplied by 4,000, that comes to the total of 2,19,428. That comes to a total of 2,19,428. What do you have done? You have used this cost per unit, because when you are issuing the item, you will use the cost per item before the last transaction. So my cost per the item before this sale, my cost per item before this sale was 54.857. Hence we have used the same price per unit to calculate the value of inventory sold. So now we have sold 4,000 units. So what is the inventory left with me? I had 14,000 of items. I have 14,000 items and sold 4,000. So the item left will be 10,000. So the item left will be 10,000. Okay. And what will be the value? That is 768. That is this 768 minus 219,428. So my value of remaining inventory will be 768 minus 2,94,28. That comes to the total of 548,572, 548,572. And if you again calculate the cost per unit, that comes to the same, that is 54.857. That comes against to 54.857. That comes against to 54.857. I am making box where we have done the most important calculation of this question. Okay. So we had opening inventory, then we have recorded to purchase, then we have sold. So whenever you sell, you will use the cost per unit from the last transaction. You will use the cost per unit after the last transaction as given in the balance section of the answer, as given in the balance section, that is 54.857. Okay. And after selling, we will again write the balance which is left with you. We will again write the balance which is left with you. So this is the balance after the sale. Now we have one more transaction left regarding the purchase. We have one more transaction left regarding the purchase, that is on 22nd of January we have made purchase of 3,000 units. We have made purchase of 3,000 units. So I will write purchase of 3,000 units with the value of 2,10,000, with the value of 2,10,000. Okay. So I will write $2,10,000. What will be the price per unit? That is 2,10,000 divided by 3,000. That comes to $70 per unit. That comes to $70 per unit. Have we made any sale or issue during that purchase? No. So no entry for sale or issue. Now we have to write down the closing value. So what will be my closing value? 10,000 plus 3,000, that comes to 13,000 unit, that comes to 13,000 unit. Then 548 plus 2 lakhs 10,000, 548, 572 plus 2 lakhs 10,000, that comes to 758 572, that comes to 758 500, 758 572 will be divided by 13,000 and we will get the value of cost per unit, that is 58.35. So this is the price or cost per unit, that is 58.35, and this 758 will be my closing inventory. This is my closing inventory as on 31st of January, as on 31st of January. So what we have done, we have used weighted average of costing. We have used weighted average cost to find out the value of inventory, to find out the cost of inventory by using weighted average method. Okay. So my answer is 7,58,572, that is closing inventory as on 31st of January. Which question is this? This was question number 2 from the question bank. This was question number 2 from the question bank. And what is the answer? So your answer is option number A, that is $7,58,571, and we are getting $2 because of the round off issue. Okay, so this is the correct answer. We will check what is the correct answer as per the suggested answer. So go to the last page and see question number 2, that is option A, that is option A. So the correct answer is option A for question number 2, that is $7,58,571, that is 7,58,571, and same we are getting here, that is 578, 572 and 1 rupees because of round off. So this is weighted average. This is weighted average method where you value or you find out the cost per unit again after each transaction, whether sale, whether purchase, by dividing the number of unit that you have from the total value of the inventory that you hold. So you divide 4,20,000 from 8,000, you divide 7,68,000 from 14,000, you will divide 548 from 10,000, then you will divide 758 572 from 13,000 to get the price per unit, to get the cost per unit. So this is weighted average. This is weighted average. Now come against to the concept. Come again to the concept. What we are studying. Comes the question. What we are studying. We are studying methods of calculating the cost of inventory. We are studying the methods of calculating the cost of inventory, where we have studied that there are two methods. There are two methods. First one is FIFO, that is first in first out. Then second one is average cost, which is also called AVCO in the short, that is AB for average and CO for cost. In average cost you have two sub method. In average cost you have two sub method. That is first one is simple average, where you total all the value of purchase divided by the total number of unit purchase. Then second method is weighted average cost, where we have just seen the question number 2, which is related to the weighted average cost and how it is used to value inventory. So format for all three methods are same: receipt, issue, balance. In receipt we will write unit, price and amount, and issue we will also write unit, price, amount, and balance we will also have the section that is unit, price per unit and amount. Okay, so these are the three methods. Let's read what the weighted average cost method has to say about itself. So in this method, the weighted average of the cost of similar items is recalculated. Means calculated again each time a new item is purchased, produced during the period. So every time you make purchase of new item or produce new item, so the cost will be calculated. The cost will be calculated, or average cost is being calculated. Alternatively, same will be calculated periodically. Okay, so every time you make a new purchase, you need to calculate the cost again. You need to calculate the cost again. Like in this question, every time we are purchasing, we were calculating the cost again and again. Okay, and when we are doing sale, we again calculated the cost, which comes to the same, that is 54.857, 54.857 in both cases, before and after also. So every time you purchase or reproduce item, you need to recalculate the average cost. You need to recalculate the average cost. This is called weighted average method. This is called weighted average method, which is again the sub method of average cost. So if you look on the broader concept, you have three methods. First one is FIFO, second one is simple average, third one is weighted average. Simple average method, average comes under the heading of average cost, comes under the heading of average cost. Okay, so now I am giving you 5 minutes to read out all this concept, and then we will move again with our new concept. Okay, so I am giving you 5 minutes. Read this concept slowly, carefully, and if you have any doubt, you can message me on the group, or you can just message on the link or the comment section of this video, and we will discuss the doubts also. Okay, so read all the concept in 5 minutes. Okay, so are you done with reading all this question concept? I think so. So now comes to the next heading, that is advantages and disadvantages of these methods. So for FIFO, it is more realistic. It is more realistic value on statement of financial position, because FIFO uses first in and first out concept. So it is more realistic value that is recorded in the statement of financial position, or you can say balance sheet. And in average cost, it is complex as weighted average is required by IAS to inventory. So Calculating the value of closing inventory by using weighted average becomes more complex as compared to the FIFO because it is complex in nature, where you need to recalculate the cost or average cost after each purchase or each production. So it becomes more complex as compared to FIFO method. Okay, so this is one of the advantages and disadvantages of FIFO and weighted average, where FIFO is more beneficial because it provide realistic value, whereas weighted average becomes more complex because it need to calculate average cost after each purchase or each production. Okay, so what we have studied? We have studied the methods for calculation of the cost of inventory, where we have discussed there are two methods. First one is FIFO, second one is average cost. In average cost, we have two sub methods, which is simple cost and weighted average cost. Then we have discussed all these methods. We have solved question number 2 and question number 10 from the question bank, which from which one is of related to FIFO and second one is related to the weighted cost, and we have discussed the format and how to calculate the answers. Then last but not the least, that is last in and last out. There is one more method. Which is last in and last out, which is total opposite of FIFO. FIFO means first in first out, and LIFO means last in last out. That is, whatever the item you have purchased most recently, whatever the item or units you have purchased more recently will be given first for the sale, or will be issued first for the production. That is called LIFO, last in first out. Okay, this method is not permitted by IAS 2 inventory. This method is not permitted by IAS 2, hence it is not in your syllabus. So only there is a mention that there is one more method, which is LIFO, which is not used by IAS 2 and which is not used by other education uh, institutes like CA also, where you don't refer LIFO because it is not a method which should be used to value the value of closing inventory. Okay, so there is one more method which is called LIFO, and which hence not permitted by IAS 2 and not given in your syllabus. Okay, so in this class we have discussed the methods of calculation of cost of inventory and solve some question. Now in next class, what we need to done, we need to discuss the disclosure requirement, and last but not the least, the valuation method and its effect on the profit. This is not in your syllabus, but I have made this topic and this table for you to solve all the question which comes in your examination. We need to discuss the relationship between the price rising and price falling, and how it is going to affect your financial statement and financial position, where profit and asset are recorded. So then we will discuss this topic. First we will discuss disclosure requirement, then we will discuss valuation method and its effect on profit, and we will solve all the question which is given in your question bank. Okay, so in next class we will solve all these questions. So this is all for this class. Thank you. Hello and welcome to the another class. What we have studied till now, we have studied the valuation method of cost of inventory, where we have discussed there are two methods. First one is FIFO, second one is average cost. In average cost, we have two methods, simple average and weighted average. Then we have discussed the question and the examples which are related to these method. Then we have discussed the advantages and disadvantages of being in a FIFO or being in an average cost system. Then now we have to discuss the two remaining topics, which are disclosure requirement and valuation method and its effect on the profit. Okay, so let's start with these topics. So first topic is disclosure requirement. Now what is disclosure? Where you need to disclose the information in your financial statement, So in each IAS we have certain disclosure requirement which required us to mandatorily disclose some information which is related to the preparation of financial statement, or which is related to the scope of the item which is against regarding which the IFRS or IAS has been issued. So now we have to discuss the disclosure requirement. So for manufacturing business, what is manufacturing business? Where suppose I am the manufacturer of t-shirts, so I will purchase raw material, then use or process the raw material and make the final t-shirt to be sold in the market. So for manufacturing business, the disclosure should include the accounting policy for inventory and a breakdown of inventory into appropriate classification such as raw material, comma, work in progress and finished goods. So if you are in a manufacturing business, you need to disclose the accounting policy that you have used for the valuation of inventory, and you should break down the inventory into three parts. So that is raw material, work in progress and finished goods. In the meaning of inventory, in the first class we have discussed the meaning of inventory, where we have discussed what is raw material, what is work in progress and what is finished goods. So if you are a manufacturing entity, if you are in a business of manufacturing, you need to disclose that how many or how many number of units you have in your raw material and what is their value, how many of unit you have in your work in progress, what is their value, and how many of unit you have as a finished goods in your closing inventory, and what is the value of finished goods. So you need to disclose all this information in the breakdown of inventory. Also, businesses is also required to disclose the following in the financial statement. So you need to disclose further more information. First one is the valuation method that has been used in valuing the inventory. So again, apart from the breakdown of inventory, you need to disclose also the valuation method, whether you have used FIFO, whether you have used simple average, or whether you have used weighted average to find out the valuation of inventory, which has been used to value the inventory. So you need to disclose that also, which method have you used for the valuation of inventory. Again, then you have to disclose also the how the business has applied this method or those method to calculate the inventory. So you need to disclose how the business has applied the method given above. So whichever the method you have applied, you have to again disclose then how the business have applied or calculated the value of inventory using this method. So these are the disclosure requirement which is required by the IAS 2, that is inventory. Okay, so this is very simple concept. You just have to read once and then you are done with this concept. Okay, now come our last topic, but not the least. This is on the last, but this is the most important topic for your summarization of all the concepts that we have studied till now in this chapter. Okay, so the heading is valuation method and its effect on profit. So how does the change in method of valuation of inventory affects our profit? How the change, right? How the change in FIFO or weighted average affects our profit of the business. Okay, so inventory valuation level depends on the volatility. What is volatility? That is changes of price and valuation method used. Okay, so the value of inventory depends on two things. First is change in price, suppose change in purchase or change in cost of the inventory, and the valuation method used. Okay, so we will discuss each case one by one. First we will discuss what if the price are rising, and second we will discuss what if the price are falling and how it is going to impact our valuation, our profit in each cases of method of inventory. Okay, so first we will discuss what if the price are rising and how it is going to affect our FIFO, and what if we are using average cost. Okay, so let's start with the simple example. Okay, suppose during the accounting period I have made following purchases. That is, first 100 units at the rate of $10, then 150 units at the rate of $20, and then 300 units at the rate of $12. Okay, and in the meantime, same I have sold 80 units at the rate of 30, then I have sold 60 units at the rate of 30. Okay, so green one are my purchases, red one is my sales. Okay, now I have to find out what will happen if I use FIFO. What will happen if I use FIFO? FIFO means first in, first out. So if I am using FIFO, my closing inventory will be if I am using FIFO. Okay, let's do one thing. We will change price here also. Okay, let's do the price to 25 per unit because price are rising, है ना? price are rising. This is the case where price are rising. So price rose from 10 to 20, 20 to 25. Now we are doing value of closing inventory by using FIFO. So first you have 100 units, then you have 150 units. So 100 plus 150, that comes to 250. Then you sold 80 units, then you sold 80 units. Okay, so you are left with 170 units. You are left with 170 units. Then again you have purchased 300 units, so you are left with 470 units. Then again you have sold 60 units, so you are left with 410 units. This is the closing number of units that you have on your business. So we are using FIFO. We are using FIFO. Okay. So for using FIFO, if we do the rough calculation and by not making the format for the complete solution, what will be the value of inventory that you have? Suppose on from 100 units and from 120, and then you have sold 80 units. So that 80 units will be sold from 100 unit first. That 80 units will be sold from 100 unit first. So you will be left with 20 units only. Okay, and then you will be left with 150 units only after this sale. I am just giving you the example how it is going to affect. Okay, so just be with me. First we have sold 80 units, so that 80 units will be used from this 100 units. So you will be left with the total of 20 units, and from this purchase you will be left with all 150 units. Okay, then you have purchased another 300 units, so you will be left with another 300 units. Now when you sold 60 units, so first these 20 units will be used. Okay, so from 60, first this 20 unit will be used, and then this 40 units will be used. That is, you will be left with 110 units. You will be left with 110 units. So you will be left with 110 units at the rate of $20 each, and you will be left with 300 units, that is this one, at the rate of $25 each. Okay, I am just doing on a rough calculation, and I'm just doing the rough calculation. You can also make the format and get the same value. Okay, so you will be left with 300 units at the rate of 25 and 110 units at the rate of 20. So 110 multiplied by 20, that comes to 2200, and 300 multiplied by 25, that comes to 7500. So your value of closing inventory will be 2200 plus 7500, that comes to $9700. This is your closing inventory if you are using FIFO. Now we will solve the same question by using weighted average. We will solve the same question by using weighted average. So if you use weighted average, your value of closing inventory will be, let's remove all this working. Okay, okay, so now you are using weighted average. Okay, so first you have purchased 100 units, then 150 units, so you will be left with 250 units in total value of 100 multiplied by 10 plus 150 multiplied by 20 plus, that comes to 4000. So the average cost will be 4000 divided by 20, 250, that comes to 16. So the 80 units that you have sold will be sold at a cost of 16, as the cost of 16 per units. Okay, then you will, after selling 80 units, you will be left with 250 minus 80, that comes to 250 minus 80, that comes to 170 at the rate of 16, that comes to 2720, that comes to 2720. Okay, I am doing this on rough. Then you have purchased another 300 units. Suppose you have purchased another 300 units. So 170 units plus 300, that comes to 470, and 2720 plus 300 multiplied by 25. So 3000 multiplied by 25, that comes to 300 multiplied by 25, that comes to 7500, plus 2720, that comes to total of 10220. divided by 470 comes to the cost per unit, that is 21.74. That comes to the total cost of 21.74. Now you have sold 60 unit. Now you have sold 60 unit. So 470 minus 60, that comes to 410 at the rate of 21.74. At the rate of 21.74, that comes to the total of 410 multiplied by 21.74, that comes to a total of 8913.4. That comes to a total of 8913.4. So your closing inventory by using weighted average will be 410 units at the rate of 21.74. That comes to 8913.4. That comes to 8913.4. So what we have got, try to understand. I have done this in rough basis so that we can quickly understand what I am trying to tell you, so that we can quickly understand what I am trying to tell. In this case the price are rising. In this case the price of purchase are rising. Okay, so the first purchase was made at the rate of $10 per unit, then second time when we made purchase it was made using $20 per unit, and then third time when we made purchase it was done by using 25 units per $25 per unit. So this, in this case the prices are rising. In this case the prices are rising. So if we use FIFO, the value of closing inventory was 9700. The value of closing inventory was 9700. But when we used weighted average, the value of closing inventory came to 89130. So what we concluded? We concluded when the prices are rising, FIFO will give you more value of closing inventory. The FIFO will give you more the value of closing inventory as compared to the average cost, whether if you use simple average, whether you use weighted average. I used it weighted average just to make you more clear about the concept, about the terminology. Okay, so what we got that if the prices are rising we will get more value of closing inventory in the FIFO method as compared to the simple average or weighted average. Okay, this is the case. Now comes to notes. What is the case? The case is if the prices are rising. If the prices are rising, if the prices are rising and we use FIFO method, so it will result in higher inventory valuation. Okay, and in the first class we have discussed higher the value of inventory, higher the gross profit. So if we use FIFO, in the case when the prices are rising, the inventory value will be higher. And higher the inventory, higher the gross profit. We have discussed in class first where we have seen this chart, or table where we have discussed that closing inventory is overstated, then the profit or the net income will also be overstated. Okay, so if the prices are rising and we are using FIFO method, so it will give you higher the value of closing inventory. And higher the value, higher the gross profit will be. And ultimately it will result in lower cost of sale, because if you make more profit then the cost of sale will be lower. If you use FIFO method. And same case if you use average cost method, it will result in lower inventory valuation. As we have seen in this case, if we use weight average, if we use average cost, it will give less value of inventory. So if the prices are rising and if you use average cost of method, it will result in lower inventory valuation, and hence the lower inventory valuation, it will result in lower gross profit. Like this. Closing inventory is understated, then your profit, then your net income will also be understated. So higher the inventory, higher the profit. Lower the inventory, lower the profit. Okay, and hence if you have the lower profit, your cost of sale will be higher. So what I am trying to make you understand is the cases where if the prices are rising, FIFO will give you more the value of inventory as compared to the average cost, and hence in FIFO you will have the higher gross profit and lower cost of sale, and in average cost you will have the lower gross profit and higher the cost of sale. This is not given in your ACCA study material. This table, this concept are not given individually or separately in your ACCA study material. I have made this from the summary of all the content. I have made this from the summary from the question which the institute has asked till now. Okay, so this is my own creation where I have summarized the cases and how the it will impact our inventory valuation, where and how it will going to impact our inventory valuation. So the first case is, if the prices are rising, FIFO will give you more inventory valuation and average cost will give you less inventory valuation, and how it is going to relate it with the gross profit and cost of sale. This is in front of you. Okay, so we have given you the logic also by using this example where we have solved the same equation, same question by using different method when the prices are rising. Now we have to study what if the prices are falling, what if the prices are falling. Okay, so our second case, what if the prices are falling, and we will use FIFO and average cost. What will happen if we use FIFO and average cost? Okay, now it is vice versa. If the prices are falling, you will have lower inventory valuation in FIFO. You will have lower inventory valuation in FIFO and lower the gross profit and higher the cost of sale. And if you are using average cost and prices are falling, then you will have higher the inventory valuation, higher the gross profit and lower the cost of sale. Okay, so this is the relation between rise of price and fall of price in FIFO and average cost. Okay, so now comes to the logic side. Sir, why does this happen? It is very simple. If you are making purchases at the rate of $10, then at the rate of $20, and then at the rate of $30, and then at the rate of $50. Okay, and if you are using FIFO, so for FIFO this will be first out, this will go first. If you are using FIFO, so the item that you have purchased earlier will be first consumed first. So this will be first out, and this will be left with you as a closing inventory, So you have a closing inventory which cost you $50 per unit, and prices are rising, So this gives you the higher the inventory valuation. This will give you higher the inventory valuation because the prices are $50 per unit, So this gives you higher inventory valuation, and hence it gives you the higher inventory valuation, higher in gross profit and lower the cost of sale. And this goes vice versa when if you compare it with the average cost. Okay, so you need to read and understand and learn this table and memorize this table in order to solve all the questions which are related to these topic, which are in their question bank, So if you read this table, understand the table, you will be able to solve all the questions of this chapter. Okay, whether you are studying from me or whether you have not taken my classes, still you will be able to solve all these questions. So if you are watching this video on YouTube, if it is available on YouTube, you can take the screenshot of this table so that you can use it or refer it later. Okay, so I'm putting the screen on full screen. If you are not my student, if you don't have my notes, you can take the screenshot of this table. Okay, so first part of the table is this, and the second part of the table is this. Now after reading this, we have done with all the concept. Of this chapter. Okay, now what is left with us? We are left with question solving. So now if you have understand all the concept, we are going to start the questions of this chapter. Okay, so this is the question bank. In class 1 and 2 we have already solved some question. Now we are going to solve the remaining question. So we are not going to solve the old question which we have already solved in the class. So we have done with question number 1, we are done with the question number 2 in our last class. We are done with question number 3, we are done with question number 4. Are we done with question number 5? No, no marking is there, so I think we are not done with the question number 4. Sorry, question number 5. Now come to question number 5. Okay, come to question number 5. What question number 5 is saying? KIP or KIP. KIP deals in a single product which is experiencing rising of price, which is experiencing rising price. So we will make this arrow, we will make this arrow. Prices are rising. If KIP adopt FIFO approach to inventory valuation, what would be the effect on his gross profit and inventory valuation as compared with an average cost approach to inventory valuation? So what question is saying? Question is saying KIP is using FIFO method and the prices are rising. So what will be the impact is compared to the average cost, as compared to the average cost? We need to discuss that. So comes to this chart. For all this question, you just have to refer this chart. Okay, comes to this chart, and what is the condition? The condition is prices are rising. KIP is using FIFO method, and what will be happen if we use FIFO as compared to average cost? So if prices are rising in FIFO method, the inventory valuation will be higher and it will be give you higher gross profit and lower the cost of sale. Now we have studied what will happen. It will give you higher the inventory valuation, higher the gross profit and lower the cost of sale. Now we will discuss what are the options do we have. So our first option is option A, that is higher gross profit and higher inventory valuation. Is this the case? Yes, is this the case where we will have higher gross profit and higher inventory valuation? Okay, but before jumping to the conclusion, we will see all other option also. We will check all other option also. Option B, lower gross profit, higher the inventory valuation. No, this is not the case, because inventory valuation and gross profit are related to each other in a direct manner. They are not inversely related, they are directly related. So option B is wrong. That comes to option C, higher gross profit, lower inventory valuation. No, this is also inverse relation. We do not have an inverse relation when we compare inventory valuation with the gross profit. Then comes option D, lower gross profit, lower inventory valuation. No, this is not the case. It will be the case if the average cost is compared with FIFO, but here we are comparing FIFO with the average cost. So in FIFO we will have higher gross profit and higher inventory valuation. So the correct option will be option A. The correct option will be option A. We will check all the answer at last with our suggested answer. So for question number 5, the correct answer is option A. Okay, if you want, we can just check the answer. We will go through the last page and check what is the answer. So for question number 5, the correct answer is option number A. Okay, when the inventory valuation will be higher and gross profit will also be higher. So we have done with question number 5, which is based on the last concept that we have studied about the inventory method and its effect on the profit. Now comes to next question, that is question number 6. We have already done question number 6 in previous classes. Then question number 7, I think we have also done with the question number 7. Then we have question number 8. So we have question number 8, that is indicate whether each of the following statement about inventory valuation is true or false. So what we have to do, from the following statement we need to find out whether these statements are true or false. Okay, so now comes to the statement. So what statement A is saying? Statement A is saying profit will be higher when using FIFO if prices are falling. Statement A is saying profit will be higher when using FIFO if prices are falling. No, this is not the case. In FIFO, profit will be higher if the prices are rising. If the prices are rising, we have seen this in the table. If the prices are rising, FIFO will give you higher profit. FIFO will give you higher profit. So this statement is false. This statement is false. Okay. So this statement, that is statement A, is false. Now comes statement B. Statement B. Inventory valuation will always be lower when using average cost rather than FIFO. What option B is saying? Inventory valuation will always be lower when using average cost rather than FIFO. It will not always be lower. It will not always be lower. When you say always, it will include all the cases. It will include all the cases, all the circumstances. But it will not be always. It will only the case if the prices of inventory are rising. If the prices are rising. If the prices are rising, then only average cost will show you the lower value as compared to the FIFO. But this is not the case always. This is not the case always. So this statement is also false. This statement is also false. So what is the correct answer? Where both statement A and B will be false. So correct option will be option number D, where A and B both the statement are false. Where statement A and B both the statement are false. Okay. Now comes to question number 9. Okay, these are very simple question if you study the concept. If you refer these notes, you will be able to solve all the questions that are in your question bank. And from where this question bank has been prepared? This question bank has been prepared by using ACCA Study Hub. Okay, so you don't have to refer any other material. If you solve this question bank, you will be good to go for the examination. Okay, so question number 9. Billard's business started the year with 240 units of inventory with a value of 2400. So Billard's business started the year with 200 units with the inventory value of $2,400. So what is this? This is opening inventory. What is this? This is opening inventory. During the year, Billard's purchased 4,800 units costing $57,600 full stop. 4,200 units were sold for rupees 1,26,000. Don't get confused. Where it is saying 4,200 units were sold for. For means this is the sale value. This is the sale value. This is the not the cost of sale. This is not the cost of sale. This is sale value. Okay. Don't get confused. Then, assuming the opening inventory was sold first, what gross profit was made by Ballard during accounting period? So we need to find out the gross period. We need gross profit. We need to find out the gross profit during the accounting period. Okay. Also, the question tells you assuming the opening inventory was sold first. So which method are they using? Which method are they using? They are using FIFO method, where first in and first out. First the opening inventory will be sold, then your purchase will be sold. Okay, so they are using FIFO. But you don't need to calculate closing inventory. You need, the question is asking for gross profit. The question is asking for gross profit. So now tell me, what is the formula of gross profit? If I ask you what is the formula of gross profit, so the formula of gross profit is gross profit equals to sale minus cost of sale. The formula of gross profit is gross profit equals to sales minus cost of sale. Now you will say, what is the formula of cost of sale? Okay, so what is the formula of cost of sale? The formula of cost of sale is opening inventory plus purchase minus closing inventory. So the formula of cost of sale is opening inventory plus purchases minus closing inventory. So opening inventory is given in your question. You are given with the amount of opening inventory and value of opening inventory. You are also given with the amount and units of purchase. You are given with the amount of unit and value purchase. You need to find out what? Closing inventory. You need to find out closing inventory. You are also given with the value of sale, that is $1,26,000. Okay, so you have sale, you have opening inventory, you have purchase. What do you need? You need closing inventory to find out the value of cost of sale. Then you will use that cost of sale in the formula of gross profit, and you will ultimately get the answer, that is gross profit. Okay, so this is a very good question. let's mark star on it. This is a good question where all your concepts are going to be checked. So comes to our notes, and we will solve question number 9. We will solve question number 9. Okay, which method is going to be used? FIFO. And what is our format? That is receipt, then issue, then balance. And for receipt you have units, then you have price, and then you will have amount. And same for here, unit, price, amount, unit, price, amount. Okay, so you have opening stock, that is 240 units for 2400. So we will write opening stock 240 units, 2400 each, that is 10 per unit, Okay, now they have made the purchase of 4800 units at the total value of 57,600. So they have made 4800 at the rate of 57, at the value of 57,600. So 57,600 divided by 48, that comes to the value of 12. And no sale during this date, and you will be left with the closing value of 2. Then you will left with the closing value of, we will write with the blue color, 240 at the rate of 10, that is 2400, and 48 at the rate of 12 with 57,600. This is your closing inventory after the first purchase. Then have you made any other purchase? No, you have not made any other purchase. You have sold 4200 units. Now we have to sold 4200 units. No purchase, and now we are writing order the sale. So first 240 unit will be used because we are using FIFO. So first 240 unit will be used. So 240 at the rate of 10, that is 2400. How many units have been sold? That are 4200. Okay, so 4200 are going to sold, and first we will use 240 units from our opening stock. So what do we need from our next purchase? That is 4200 minus 240, that comes to 3960. So we will use 3960 from this purchase, that is at the rate of 12. Okay, so 3960 multiplied by 12, that comes to 47520. Okay, now what we are left with? We are done with 240 units, so we do not have any opening inventory. And from 4800 of units, we have already used 3960. So 4800 minus 3960, that comes to the total of 840. So 840 at the rate of 12, that is 840 multiplied by 12, comes to the total of 10,080. That comes to a total of 10,080, and this 10,080 is your closing inventory. Okay, so we have find out the value of closing inventory by using FIFO. Now question is not asking for closing inventory, question is asking for value of gross profit. Okay, so now we will find out first what? Cost of sale. The formula for which is opening inventory plus purchase minus closing inventory. I am writing the short form of it because the question is going to be solved on a MCQ basis. So you are not going to get answer for this rough calculation. You will get the answer for the right answer only. So what is opening inventory? Opening inventory value is 2400. Okay, 2400. So 2400 plus purchase has been made for 57,600 for purchase 57,600, and your closing inventory, that is 10,080. That comes to the total of cost of sale, that comes to the total of 2400 plus 57,600 minus 10,080, that comes to a total of 49920. That comes to a total of 49920. That is cost of sale. Now we need to find out gross profit. That is sale value minus cost of sale, that is sale value minus cost of sale, that comes to a total of sale, that is 1,26,000, that is $1,26,000 minus 49,920, that comes to a total of 1,26,000 minus 49,920, that comes to 76. Sorry, my pencil battery has gone. 1 minute. That comes to a total of 7680. 76080. This is the amount of your gross profit in dollar. 76080. Okay. If we see the option given, then we can see this is the correct answer. 7680 is your correct answer. This is your gross profit that you're going to earn from this transaction. Okay, this is one of the good question, one of the best question. Please mark it star. It will come again in our examination. There are chances. Okay, so the correct option is option B, that is 7680 of question number 9. Let's check what is the correct answer of question number 9. So option number 9 is question number 9. Option is option B, that is 76080. Okay, and we have wrote mark the correct answer, that is this 76080. What we have done? We had opening stock, we had purchase, we had sale value, and we were required to find out the value of gross profit. So what is the formula of gross profit? The formula of gross profit is sales minus cost of goods sold. The formula of gross profit is sales minus cost of goods sold. And what is the formula of cost of goods sold? Opening inventory plus purchases minus closing inventory. So we have given, the question has provided us with the value of opening inventory, the question has provided us with the value of purchases, and we have the value of sale. What we required? We required the value of closing inventory to find out the value of cost of sale, and we have calculated the value of closing inventory by using FIFO method, because the question said us please assume that the first opening inventory was sold first. So this is the example of FIFO. So we have used FIFO to find out the value of closing inventory, and then by using that value of closing inventory we find out the value of cost of sale, and from that cost of sale we have used the formula of gross profit, that is sale minus cost of sale, and ultimately we are going to find out the value of gross profit, and this is the solution of this question. Okay, first we have find out the cost value of closing inventory, then cost of sale, and then at last gross profit. Okay, so this is the solution of question number 9. I hope this is easy for you to understand. Okay, then comes question number 10. We have done with the question number 10 in our previous class, which is related to the FIFO, and I think we are already done with question number 11. So we are done with question 10 and question 11. Now comes question number 12. A product called Z has the following attributes. A product which has been named as Z has the following attributes. Okay, now dollar per unit. The purchase price is 36. Carriage inwards, that is 3.5. What is carriage inward? When you pay the price for purchasing the goods, or inventory, and the sale price is 38. Trade discount of 10% of the purchase cost has been agreed with the supplier. So you are getting a trade discount of at a rate of 10% on the purchase cost. That is 36, and not on the entire value, only on 36. According to IAS 2, that is inventory, what should be included in the inventory for a unit of Z? What value should be included in inventory for the value of Z? First of all, we will discuss what is the valuation principle. So valuation principle is cost. What is valuation principle? Valuation principle is cost or NRV, whichever is lower. Okay, so first we are going to find out what is the cost. So cost is, you are getting the goods at $36 with the 10% trade discount. So 36 minus 10% comes to 32.5. That comes to 32.5. Then you were also incurring the expense of 3.5 as carriage inwards. So plus carriage inwards, that is 3.5. That comes to the value of 35.9. This is your cost. cost. Okay, now what is NRV? NRV is estimated selling price minus cost of selling minus selling or distribution expense. So your selling price is 38 and there is no cost. So your cost turns out to be 35.9 and your NRV turns out to be 38, and the valuation principle say it should be lower of both. So this is going to be your value of inventory. This is should be included in the value of inventory for the unit of Z, that is 35.9. So your correct answer is 35.9, that is option C. That is option number C. So for question 12, the correct answer is option C, that is 35.9, because your inventory valuation says that your value of inventory should be lower of cost or NRV. So we have the cost, we have deducted trade discount from the purchase value, not from including carriage inwards, because you are getting the trade discount on the purchase value only and not on the carriage inwards. And after deducting the discount, we added the carriage inwards on the net amount and got the value of 35.9. Okay, so let's check the answer. So the answer for question number 12 is option number C, that is 35.9. Answer will be option C, that is 35.9. Okay, so all the concept, all the question are based on the concept which are given in the notes. Then comes question number 13. Then comes question number 13, where Singh had Jing or Singh, you can say anything, had the following inventory on 31st of March 2008 or 2018, where you have product X, Y, Z, you have the unit cost, 4, 10, 7, you have the quantity, you have the total cost, you have the sale price, you have the sale value. Okay. To sell all the product X, Jing will have to make minor modification using costing of $67.2. So X needed a minor modification which will cost $67.2. Okay. What value should be included for inventory in the statement of financial position, that is balance sheet? You need to find out the value of closing inventory. You need to find out the value of closing inventory. And what does the valuation principle say? Valuation principle say the valuation of closing inventory or valuation inventory should be lower of cost or NRV. So we need to find out which is lower of cost or NRV, and that too in a line to line basis, on a line to line or item on item basis. So you need to find out cost NRV, whichever is lower, separate for X, separate for Y, separate for Z. Okay, so first go with X. What is the cost of X? 336. So for X, the value is 336. Cost is 336, and sales price is 5 per unit, that is 420. That is 420. Okay, but that in order to sell, X, you need a modification of that will cost you 67.2. So your NRV will be, if we write in this way, cost and NRV for X, the cost is 336. Okay, the cost is 336 and NRV will be 420 minus 67.2, that comes to 352.8. That comes to 352.8. Then if we go for Y, so the cost is 1460 and NRV is, or sale value is 1314. Okay, and we go for Z, the cost is 504 and NRV is 612. NRV is 612. Now we need to check line on line or item on item basis, whichever is lower. So if we check for X, so 336, if we check for X, 336 is lower, and if we check for Y, 1340 is lower, and if we check for Z, 504 is lower. And if we make sum of all this, that is 336, 1314 and 504, my answer will be 336, 1314 plus 504. My answer will be $2154. My answer will be $2154. So my inventory should value at $2154, and the correct option will be option C, which is $2154. Okay, what do you need to do? You need to understand what is valuation principle. Valuation principle tells us you should value your inventory at a lower of cost or NRV, and you need to check lower of cost NRV on a line to line basis and not on a total basis, you need to check that on a line to line basis or item of item basis. So what we have done, we have done x, y, z on the line to line basis, and for purpose of NRV we need to deduct the modification cost which is going to be incurred, so correct option is option C, that is 21.54. Let's check the answer with the suggested answer. So for question number 13, the correct answer is option C. Okay, now we have done with question number 13. Now please discuss what is remaining. So question number 14. 10 has the inventory records at the year end. So this is the inventory records at the end of the year. Product A12, B22 and C32. So these are the name of the product or items. Okay. Quantity is given 120, 46, 63. Cost per unit are given to you. Cost is 10, selling price is 12. Whichever is lower, we have to check whichever is lower. So 10 is lower than 12. For item B22, which is lower, 7.5 or 6, then 6 is lower. And for item C32, which is lower, 4.8. Okay, so we have checked the valuation as per line to line basis. So now what do we need? We need what amount should 10 include under the current asset for inventory 2 decimal places. So the value of inventory should be 120 units. This here the units. So 120 multiplied by 10, 46 multiplied by 6 and 63 multiplied by 4.8. If you use your calculator, you will get the exact value. Okay, so I am using the calculator. 120 minus 120 multiplied by 10, 1200. 46 multiplied by 6, 276. Then 63 multiplied by 4.8, that comes to 302.4. And if you total all these, that comes to the total of 1778.4. That comes to a total of $1778.4. That comes to a total of $1778.4. That is should be the value of your inventory. You don't, the question has not provided you the correct option or the wrong option. You have to just write the correct answer. So let's check the answer of question number 14. So the correct answer of question number 14 is $1778.4. The correct answer is $1778.4 of your value of closing inventory. So we are done with question number 14. Question number 12, 13 and 14 are based on the valuation principle, which is simple. It should be on a lower of cost or NRV, which should be lower. Okay, now let's go to the question number 15. Let's go to question 15. Shadi has purchased, Shadi is the name of a person. Okay, Shadi has purchased an item of inventory and incurred the following cost. So the purchase price is 45, irrecoverable import duty. Mark the line irrecoverable. That is, it is not going to be recovered. So it is irrecoverable and becomes the cost of the inventory, and delivery cost of 2.6. So what is the cost given? Purchase price, irrecoverable import duty and delivery cost. And if you total all these, you will get the cost of inventory, that is 45 plus 3.5 plus 2.6. Okay, now check the further information given. A trade discount of 10% on the purchase price was given to Shadi. So trade discount was given on the purchase price. So that is 45 minus 10%, that comes to 45 minus 10%, that comes to 40.5 plus irrecoverable import duty, that is 3.4 plus delivery cost of 2.6, that comes to the total cost of 3.4 plus 2.6, that comes to a total cost of 46.5. So total cost is 46.5. The item was selling, the item has a selling price of $51 and a cost to sale is 51. So what is NRV? NRV is selling price minus cost to sale, that is $50. That is $50. What amount should Shadi include in closing inventory to represent the value of his item by inventory? So valuation inventory is clear about that should be lower of cost or NRV. So this is your cost, this is your NRV, this is your cost, and this is your NRV, which should be lower, that is 46.5. So correct option is option number B, that is 46.5. So for question number 15, correct answer is 46.5, that is option B. Question number 15. Correct option is option B, that is 46.5. Okay, now come to question 16, that is a business has opening inventory of $15,000 at the start of an accounting period and closing inventory of $80,000 at the end of the accounting period. So opening inventory is $15,000, closing is 18,500. Which of the following trial balance extract correctly shows the how opening and closing inventory will be recorded in the general ledger? So you need to given are the following extract from the trial balance, and you need to find out which is showing the correct value. Okay, SFP is for statement of financial position, SPL is for statement of profit or loss. Okay, so now let's discuss what is happening. Opening inventory is your asset in the start of the accounting year, is your asset. Okay, so it will have a debit balance. Okay, so it will have a debit balance, and your closing inventory is asset for the next accounting year or for the opening inventory of next year. It is not included in the current year. What we do, we charge the entire opening into the cost of sale, and then we charge again all the purchase into cost of sale, and then we find out the value of closing inventory and get it from the cost of sale. Okay, if you look at this from the notes, that is the year end adjustment entry, then you will find out that what we charge all the opening inventory into the cost of sale and reduce our asset. As an opening inventory are your asset, so when you reduce it to zero, you credit it and debit the cost of sale. Okay, and same you do with the purchase, and at last you get the closing inventory by reversing the cost of sale and credit it the cost of sale. Okay, this is the concept which we have discussed in detail in our class number 1, okay, of this chapter. So this is your opening inventory, that is opening inventory is your asset and has a debit balance and has a debit balance. Opening will have a debit balance, that is $15,000, and closing will have a debit and credit both, because it is not going to be recorded. So now check option number 1. Option A is debit closing inventory 15,000, credit opening inventory 18,500. No, this is wrong, because your opening inventory is your asset and should not be in a credit balance. Asset should not have a credit balance. Asset will always have a debit balance. So first option is wrong. Then comes option B, that is opening inventory debit 15,000, okay, and closing inventory credit 18,000. This is correct, but this is also wrong, because you are not going to record closing inventory in your financial statement. It is going to be credited in the statement of financial statement of performance, that is statement of profit or loss, and will be shown as asset in the balance sheet. But for trial balance, your opening inventory is the asset. For your trial balance, your opening inventory is the asset and not the closing inventory. So this option is also wrong. Now comes option C. Debit opening inventory 15,000. Okay, correct. Then debit closing inventory 18,500 in statement of profit and statement of financial position, that is balance sheet. So in balance sheet will show you 18,1500, that is closing inventory as asset. This is also correct, because it is a part of balance sheet, that is statement of financial position, and credit closing inventory in statement of profit or loss, that is profit and loss account by the same amount 18,500. So this debit of closing in stock and this credit will get the nil effect, and the 15,000 of opening inventory will be shown as a asset in your trial balance. So this option is as of a most appropriate answer. This option is most appropriate because it is talking about the trial balance. It is not talking about the final accounts or financial statement. Then comes option D, that is debit closing inventory, credit opening inventory, and credit closing inventory. So this is altogether wrong. So what is the correct answer? The correct answer is option C of question number 16. This is again one of the most question which is most based on the concept. So question number 16 is the correct. Option number C of question 16 is the correct answer. Let's check the answer. So the correct answer of question number 16 is option number C. That is when you show the opening inventory as a debit and show your closing inventory as a debit in your balance sheet and as a credit in your statement of profit or loss. Okay, so we are done with question 16. Now comes question number 17, that is state whether the following statement concerning FIFO and cumulative weighted average method of valuation inventory are true or false. Okay, now we have to check whether these statement regarding FIFO and cumulative weighted average are true or false. So statement A. Statement A is in terms of rising prices, using FIFO rather than cumulative weighted average method as an inventory valuation approach would mean closing inventory will be have a higher value. What it is saying, suppose in a time of rising prices, the prices are rising, and using FIFO as compared to weighted average, will FIFO give you higher value of closing inventory? Yes, the FIFO will give you higher value of closing inventory if the prices are rising as compared to average cost. So this statement is true. This statement is true. Okay, so statement A is true because if the prices are rising, FIFO will give you higher value of closing inventory. Then check statement B. FIFO will always give a higher closing inventory valuation than cumulative weighted average cost. What the statement is saying? FIFO will always give you, the FIFO will always give you higher closing inventory valuation than cumulative weighted average cost. No, this is not the case always. This is the case only when the prices are rising. This is not the case always. So this is a wrong statement or incorrect statement or false statement because it has the word always. It is not always the case. So your answer will be where statement A is true and statement B is false. So your answer will be option number A. Your answer will be option number A, where statement A is true, statement B is false. Let's check the answer with the suggested answer. So for question number 17, the correct answer will be option A. For question number 17, the correct answer will be option A, where statement A is true, statement B is false. Now comes to another question, that is question number 18. Silur buys and store items of exclusivity jewelry at 31st of May 2007. There were 3 items in the inventory. On 31st of May 2007, there were 3 items in inventory as follows: necklace, bracelet, and pendant. You have 3 items: necklace, bracelet, and pendant. You have the purchase cost of $12,000, $31,000, and $45,000. You have the expected selling price, and then you have the restoration cost to date, and you have the further cost. Okay, there is some misprint in this question. The question is find out the value of inventory. You need to find out the value of inventory. Okay, now what is the principle that talks about the value of inventory? The principle is that value of inventory should be valued at lower of cost or NRV. So understand the question easily. Suppose, what is purchase cost? This is your cost. What is restoration cost? This is your cost. What is expected selling price? This is your expected selling price. What is further cost before sale? That is cost incurred to make the sale. So can we have the cost or NRV? Can we have the cost and NRV? We can have the cost. So find out the cost. Cost means purchase cost plus registration cost. The cost will be 12,000 plus $6,000. Again, purchase cost plus restoration cost 31,000 plus 5,000, that is 36,000. Then for pendant, purchase cost 45,000, restoration cost 2,000, that is the cost, that is 47,000. Now comes NRV. NRV means selling price minus further cost incurred before sale, further cost to incur before sale. So this is your NRV. NRV is 25,000 minus 2,000, that comes to 23,000. 25,000 minus 2,000, that comes to 23,000. Then 38 minus 3, that comes to 35. And then comes 53 minus 1, that comes to 52. So this is the cost and NRV in your 3 cases. Okay, now find out the value of inventory. So which should be lower? We need to find out whichever is lower. Okay, so what is lower? 18,000 is lower than 23,000. In this case, 35,000 is lower than 36,000, and in this case 47,000 is lower than 52,000. So if you make the total will be 15,000 plus 35,000 plus 47,000, that comes to the total of 1 lakh. that comes to a total of 1 lakh. Okay, so total of all this 18,000 plus 35,000 plus 47,000 comes to a total of 1 lakh. So this is the value of your inventory in question number 18, where what you have done, you have done the valuation in the lower of cost or NRV. Let's check the answer with the suggested answer. So answer of question number 18 is this 1 lakh. So the answer of question number 18 is 1 lakh. This is all based on the concept which are given in the notes. So what you just need to solve the notes, or you just need to read the notes, and you will be able to solve all the questions. Okay, now we will finish this chapter. We have only 26 questions. We are now in question number 19. Okay, so question number 19. The following figures relate to inventory held at 31st March 2006. Okay, you have two product, product A and product B. You have the units, you have the cost, you have the selling price. Modification costing $5 per unit would need to be made to product A to achieve the selling price. So product A required a modification of $5 each. Okay. What is the value of inventory held on 31st of March 2006 in accordance with inventory valuation? So you need to again find out which is where is lower, cost or NRV. Okay. So for A, the cost is 14 and NRV is 17 minus 5, because it is the modification, because it is the modification which is required to make the sale. Okay, so 14 or 17 minus 15, that is 20. So what is the valuation? That is 14 or 12, whichever is lower, that is 12. And for B, the cost is 16 and selling price is 20, so value is 16. So A has a unit of 2000 multiplied by 12 and B has a unit of 5000 multiplied by 16, that comes to 2000 multiplied by 12, that comes to 24,000. 5000 multiplied by 16, that comes to 80,000, and hence the total will be 1,04,000. So the correct answer of this question is 1,04,000. That is option number D. That is option number D. What we have done, we have again done a simple from question number 12 to question number 19. We have only used one principle, that is lower of cost or NRV. Okay, so this modification will be charged as NRV, will be reduced from the selling price. Okay, question number 19 answer is option number D, that is 1,04,000. That is 1,04,000. Okay, answer to question number 19. Now comes my favorite question, and that is too important for you. Market star. Question number 20. The draft 2006 statement of financial position. The draft 2006 statement of financial position, that is balance sheet, reported retained earning of $16,44,900 and net asset of $69,57,300. It was then discovered that several times in opening inventory had been valued at selling price. So what was discovered? The discovery was that several times in opening inventory had been valued at selling price. Okay, so your opening inventory was wrongly valued at a selling price. This resulted in $3 lakhs overstatement of opening inventory. This resulted in $3 lakhs overstatement of opening inventory. The closing inventory had been correctly valued in the draft 2006 financial statement. The closing statement inventory had been valued correctly. What are the correct figures for retained profit and net asset in the statement of financial position for 2006? What is the case? The case is you are given with the amount of retained earning, you are given with the amount of net asset. Okay, and the question is saying that several times the opening inventory had been valued wrong on the selling price. So selling price, opening inventory had been valued over selling price. The opening inventory had been valued overstated. That is by $3 lakhs. That is by $3 lakhs. So what will happen if you have the higher opening inventory? That is on the last year. On the last year, your closing inventory was overstated. That's why your opening inventory is overstated in your current year. So what happened when you have the overstated closing inventory? When you have the overstated closing inventory, your profit will be higher, your asset will be higher. Okay, what will happen if you have the overstated closing inventory, your profit and your net asset will be higher. Okay, this is correct. Now question is saying the closing inventory had been correctly valued. Your closing inventory had been correctly valued. So whatever the wrong had been done in the opening inventory had been corrected in the closing inventory. If the question is saying the closing inventory had been correctly valued in draft 2006 financial statement, that means whatever the wrong or overstatement was there in opening inventory had been corrected in the closing inventory. Hence, it has compensated the error. Hence, it has compensated the error. Okay. So, if you have corrected your closing inventory, so it will correct the misstatement or wrong working in your opening inventory. So your it has compensated the error. Now question is asking what are the correct figures for retained profit and net asset in the statement of financial position. Question is asking what is the correct answer. Now you have this value for retained earning and net asset, and if the error is compensated by the correction of closing inventory, then there will be no change in the retained earning and net asset. Then there will be no change because whatever the error that you had in your opening inventory is corrected by the correction of closing inventory. So your correct amount will be same 16,44,900 and 69,57,300. That is the correct option will be option number B. The correct option will be option number B, which has the same value, that is 16,44,900, 16,44,900, 69,57,300, 69,57,300. This is the one of the good question where it talks about the compensation of error. You don't need to do any calculation, you just need to read the question and you will be able to solve the entire question. Okay, so correct option will be option B. So if we check correct suggested answer, suggested answer for question number 20 is question number B. Is question number B. Okay, now so mark 20 question number 20 as a important. It will come in your examination. There may be chances. Now comes to question number 21. Hannah makes electrical goods for retail customer. She has 10,000 washing machine and 15,000 computer. She has 10,000 washing machine and 15,000 computer in inventory. The following value relates to each item of inventory, where you are given with the cost, you are given with the selling list of selling price, selling expense, and trade discount offered to customer. So you have the cost. So cost is 200 and 100. We need to find out NRV in order to get the value. So what is NRV? 500 minus 5% that is 47.5 less selling expense 47. So you will what you will get 500 minus 5%, that's 475, and then you will offer a then you will incur selling expense of 75. So your NRV will be 400 for washing machine, and for computers you have the selling price of 150 minus 10%, that comes to 135, and you will incur a selling expense of 25. So your NRV will be 110. So these are the NRV 400 and 100. Now you need to check which is lower, cost or NRV. You need to check which is lower, cost or NRV. Okay. So for washing machine cost is lower 200, and for computer cost is again lower by 100. So 200 multiplied by 10,000 unit of washing machine, 100 multiplied by 15,000 unit of computer, that comes to 20 lakhs, and that comes to 15 lakhs, that comes to a total of 35 lakhs, that comes to a total of 35 lakhs. So your correct answer will be 35 lakhs dollar. Your correct answer will be 35 lakhs dollar. Let's check the answer of question number 21. So the correct answer of question number 21 is 35 lakhs dollars. Okay. This is again based on the concept of valuation of inventory, lower of cost or NRV. So you should know what will be included in cost, what will not be included in the NRV. If you don't read the notes, you will not be able to understand the concept which are in the question. Okay, now question number 22. Which of the following statement is correct? Which of the following statement is correct? We need to find out the correct statement. Okay, so option number A. Carriage inwards and outwards are both expense. Correct. Which can be validity included in the establishment of cost of inventory? No. Carried outwards does not get included in the cost of inventory because it is related to the sale. When you sell the goods and when you incur the carriage, when you sell, it is called carriage outwards. So carriage outwards does not form the part of the cost of inventory. So option A is wrong. Then comes option B. Carriage inward is an expense, but carriage outward is a sundry income. Carriage outward is a sundry income. No, carriage outward is not a sundry income. It is also a expense, but a indirect expense. Then comes option C. Carriage inwards and outwards are both expense. Yes, but only carriage inwards can be validity included where appropriate in the valuation of inventory. Correct. Both are expense, but only carriage inwards are going to be included in the value of inventory. Option D. Carriage inwards and outwards are both expense, but only carriage outwards are going to be included. No, only carriage inwards is going to be included. So correct option is option C, where only carriage inwards is going to be included. Question number 2, option number C is the correct answer. Option number C is the correct answer. Okay. Now we have also discussed this in our notes. Okay. So if you read the notes, you will be able to understand the cost of purchase, purchase price, purchase import duties, and this carriage inwards is going to be included, carriage onward is not going to be included in the value of inventory. Okay, so we are done with question number 22. Correct option is option C. Now comes question number 23. Bhumi has 120 units of an item in inventory which were purchased some time ago at a cost of 1200. Immediately before the end of the financial year, 20 units were sold for $180. So before ending the financial year, 20 units were sold for $180. Shortly after the year ended, as further 20 units were sold for $170 with $20 being incurred in delivering the items to customer. Okay. At what amount should the item inventory at the end of financial year be included in the financial statement? Question is saying what is the value of inventory of closing inventory. Okay. Now read the question again. Bhumi had 120 unit of an item in inventory which were purchased some ago at a cost of 1200 immediately before the end of financial year. So Bhumi had 120 items. Okay, this is your accounting period. 20 units were sold for $180. 20 units were sold for 120 immediately before the end of the. Now read again. Now this is a separate line. Immediately before the end of the financial year, 120 units were sold for $180. Okay, so suppose this is year end. And you have 120 units. And before end of the and immediately before the end of the financial year, you have sold 20 units. For $180, and shortly after the year end, a further 20 units were sold for $170. So after the end of the year, you again sold 20 units at a $170 with $20 being incurred as delivering cost of the item. Okay. Question is asking what amount should the item of inventory at the end of the financial year be included in the financial statement. Okay. Now you have the information of the sale before the year end and you have the information regarding the sale after the end of the year, and you need to find out the value of inventory at the end of the year. You have information of both. What was the selling price before the end of the year and what is the selling price just after the end of the year. You have the information of both. Okay. Now we have to check which is lower, cost or NRV. So which is cost? Cost is $1,200 for 120 units. So cost is 1200 divided by 120, that comes to $10 each. Okay, now we have to discuss the NRV. So what is the NRV here? So NRV here is 180 divided by 20, that comes to 9. That comes to $9. And what is the NRV here? So NRV here is 170 minus $20 that you have incurred for sale divided by 20 units, that comes to 150 divided by 20. 150 divided by 20, that comes to $7.5. So which is lower, cost or NRV? So this NRV, that is 7.5, is lower than the cost, because we have the information of the sale made after the year. Valuation principle does not say that you should only use the NRV before the end of the year. You can also use the NRV which you know which is happening after the end of the year. So NRV is 7.5. Okay, so how many units do you have? How many units do you have? That is, how many units do you have? You had 120 units, of which 20 you have sold. So you, in the end of the year, you are left with 100 units. At the end of the year, you are left with 100 units, because question is saying Bhumi had 120 units of an item in inventory which were purchased some time ago at a cost of 1200. Immediately before the end of the year, 20 units were sold. So from 120, 20 was sold. You are left with 100. So 100 units multiplied by NRV, that is 7.5. How we got 7.5? 170 minus 20 of delivering the item divided by 20 units, that comes to 7.5, and that comes to a total of 7050. That is option number A. 750 is the answer of the value of inventory, that is lower of cost of NRV. Okay, so answer of question number 3 is option number A, that is A, $750. Okay, now we are only left with 3 questions, that is question number 24, question number 25, question number 26. On 1st of January, Mobi purchased 100 units of a good for a resale of $1 lakh. On 1st of March, 20 further units were bought for 20,400, and on 1st of August, 30 units were sold for 33,000. What is the cost of remaining inventory using the FIFO? Okay, so first they have 100 units at the rate of 1 lakh. So unit per price is 10. Then they have not made any purchase, they have not made any sale, and then on 1st of March they have made a purchase of $20 units at the rate of 20,400. So 20,400 divided by 20 units comes to the cost of 120. On 1st of August, 30 units were sold. So 30 units were sold, and they are using the FIFO method. So what we will use? For selling the 30 units, we will use this first. So 30 at the rate of 10, that is 30,000. So what we will left with? We will be left with 70 units at the rate of 10, that is 70,000, and $20 of 120 each, that is 20,400. And then we will left with the total value of 90,400. Then we will left with the total value of 90,400 if they are using FIFO, and option will be 90,400. Correct option will be option number B, which is $90,400. So question number 24 is option number B. This is too simple for us. Okay, so we are done with question number 24, which is regarding the valuation of inventory as per FIFO method. Now comes question number 25, one of the second last question. So question number 25. On 1st of January, Mobi purchased 100 units of goods for resale for $1 lakh, and 1st of March, 20 further units were purchased, and on 1st of August, 30 units were sold. This is the same question which we have seen question number 24. Only last line has been changed. If Mobi used the average cost method instead of FIFO, what would be the effect of inventory valuation and reported profit? Now it is saying again effect of valuation principle and price on the profit. Okay, so let's check whether the price are going up or down. Okay, so if Mobi has used average cost method instead of FIFO, so first the price of the purchase was $10. Guess how we got the $10? 1 lakh divided by 100 units. Okay, 1 lakh divided by 100, that is 1000. Sorry, 1000. Okay, Then on 1st of March further units were bought for 20,400. So 20,400 divided by 20, that comes to 120, and this is 1000. Okay, so price are rising. Okay, so if the price are rising, so if you use average cost, your value of inventory will be lower, your value of inventory will be lower. Okay, so value of inventory will be decrease, and if the value of inventory will decrease, your gross profit will also decrease. So gross profit will decrease and inventory value will also decrease. So your correct option will be where both goes down. So option A no, B no, C no, and D. D is the correct answer because prices are increasing. First the price was 1000 units, second the price was 120 units, and if the prices are increasing, so FIFO will give you higher valuation, average cost will give you lower valuation. So if you are using average cost instead of FIFO, it will give you lower inventory valuation and lower reported profit. Okay, so profit will be decrease and inventory valuation will also decrease. So option number D is the correct answer. Question number 25, option number D is the correct answer. Now, our last question, then we will finish this chapter and finish this class. Question number 26. Papyrus company sell 3 products, Mini, Maxi and Mega. The following information about inventory is available at the year end. Mini, Maxi and Mega. You have the information regarding the units, you have the information regarding the cost, you have the information regarding the estimated selling price and NRV and selling cost. So you will have the NRV, that is 18 minus 3, 15, 22 minus 17, 22 minus 5, 17, and 15 minus 2, that is 13. Okay, so this is the NRV. So you have the NRV, that is 15, 17, 13, and you have the original cost, that is 12, 18, and 10. Now, which is lower? So 12 is lower, 17 is lower, and 10 is lower. If we have to find out the value, then Mini will be 200 unit multiplied by 12, Maxi will be 240 units multiplied by 17, Mega will be 300 units multiplied by 10. That comes to the total of 200 multiplied by 12, 2400, 240 multiplied by 17, 4080, 300 multiplied by 10, 3000, and if you make the sum of all this, that comes to a total of 200, 400, 4080, and 3000, that comes to a total of 9480. This is the value of inventory, that is option number B, $9480. This is the answer, and it should be based on the lower of cost or NRV. Let's check the last answer. Question number 26, option B, that is 9480. Okay, so with this we have solved all the question from 1 to 26 of chapter 8, that is IAS to inventory, and we have discussed all the provisions of all the concept of this chapter in the class. So this is all for this chapter. If you have any doubt, you can contact me and I will solve all the doubts of yours. Okay, so thank you. Please revise this chapter and we will meet with next video on the next chapter. Okay, so this is all for this class. Thank you.